market, do they focus on what we learned from the household survey or the establishment survey? Does more weight go on one versus the other? I'm kind of intrigued in how Chairman Powell's going to navigate that story.
It's a great question, because the way they interpret that, if they increase that even by a percentage, by a tenth of a percentage point, there will be an interpretation in the market that they see more weakness. What do they see that we don't see? The answer is nothing, but the question is, the emphasis sort of opens more of the door to potentially cutting rates sooner. It's not that they necessarily have a crystal ball, but it might give you a sense of where the emphasis is, to your point, based on some of the conflicting information we've been getting.
I think the chairman has basically already told us he's not too worried about upside inflation risks, is concerned about downside growth risks. And it's what he says about that today that I think is going to be really important, which is why people like Andrew Honhorst over at Citi are looking for a dovish news conference. Now, I know he's pushed out his rate cut over the last week or so after payrolls. What was it, to September?
Yep.
Something like that. He still thinks we get a dovish news conference today.
Well, and he sort of is in line with Steve Rasciuto in the sense that it doesn't really matter when you start. It's the same number, and it's sort of the time frame that you just sort of push out to next year. You do raise a bigger question here, though, which is essentially how much they're looking at a potential economy that maybe the inflation isn't at risk of going higher, but what if it's sticky? And that, how do they deal with that? And that's sort of the question that Steve Rasciuto raised. How do we understand restrictiveness? Bill Dudley really raised that. Neil Kashkari's talked about that. Do they address that in some of their commentary today? My guess is not, but we really hope they do, because this is underpinning a lot of discussion.
I'm just thinking of Mike Schumacher from yesterday over at Wells Fargo. This is a losing game. It's a losing game. Trying to predict any of this has been a losing game now for months.
And we get to play it every single day. Welcome. This is Bloomberg Surveillance, where we play losing games.
And we'll play it again at 8:31. Looking forward to that after CPI drops. Your scores look like this on the S&P 500, positive by 0.1%. In the bond market, yields lower by almost a basis point on a 10-year, 439.62. One person around this table is very focused on debt auctions. Supply was actually decent yesterday afternoon.
This was interesting. It was a $39 billion auction of 10-year notes. These have traditionally been really bad over the past few months. This came in very strong. Dealers took down a much lower percentage. Non-dealers came in with a much bigger percentage. Why? Are they sniffing out some sort of weakness or sort of disinflationary
Is that your
trend?
takeaway from yesterday?
Yeah.
So if it went bad, it's bad. If it went well, it's bad too.
Well, it's not that it went bad. I mean, disinflation is good, but they might be sensing that there is a sense that there isn't the worry of the Liz Truss moment that other people think that there is potentially out there. The ghost of the Liz Truss moment, not her.
Yes, not her, because she's still very much with us, okay? Coming up this hour, Bank of America's Savita Subramanian and why the bears are looking through the wrong end of the telescope. She can translate in just a moment. Bloomberg's Ollie Crook as Europe announces fresh tariffs on Chinese EVs. And Winnie Caesar of credit sites on CRE risks to regional banks. We begin with our top story. Stocks at all-time highs. Ahead of today's doubleheader, Savita Subramanian of Bank of America maintaining a year-end price target of 5,400 on the S&P and writing this: data has softened, economic surprises are starting to skew negative, and if inflation doesn't moderate, the Fed won't cut rates. Stagflation is back on bears' lips. But zooming out, we see healthy, not recessionary macro trends. Savita's with us around the table. Savita, good morning to you.
Good morning.
What is looking through the wrong end of the telescope? What does that mean?
Yeah, so I think that we're all focused on just what's happened over the last couple of years. And if you look at a chart, like open your Bloomberg and look at a chart from year to date or the last 2 years, it does show softening trends in most of these barometers. It shows that inflation is down, thankfully, from very, very high levels. It shows that delinquencies are up a little bit. But then if you kind of take your fingers and squish that and zoom out all the way to, you know, a 50-year time horizon, which a lot of this data encompasses, things today are actually kind of awesome. To use a technical term. And what I mean by that is we are at a delinquency level that's generally lower than where we've been in even normal cycles of the past. Financial obligations, same story. If you look at jobs, we're in a healthy level, but not super tight like we were coming out of COVID. So I kind of feel like there is this case to be made, and I know everybody hates the word Goldilocks, but we've talked about this before. I mean, everyone is so focused on what could go wrong, and I think it's because we've been trained by cataclysmic events that have happened in our careers. We've seen COVID, we've seen the global financial crisis, we've seen LTCM, Russia, Asia. We're all about crises and tail risks at this point, and that's our base case. I think the base case is something in between. I mean, if you look at the probability of a recession or stagflation actually happening, very low, 10% of the time or less, we get stagflation or a meaningful slowdown. most of the time we get some semblance of Goldilocks. So that's the view that we're espousing, is until things really start to fall off a cliff, until we see broad spread job losses, until we see the consumer really deteriorate on all of these measures, it's not necessarily time to throw out equities.
Can you make the argument that that story is already priced?
I can't, because what's interesting is that if you look at the spread between defensive or secular growth companies and the rest of the market, still very wide. So I would argue that folks have been forced into the equity market because it's run up, and obviously forced into these 7 magnificent companies. But there is a very small exposure to cyclicals. In fact, if you look at the beta of the average mutual fund right now, an actively managed investor, professional investors, their beta exposure is at all-time lows. That's not a bet on an up market. That is a very defensive level of risk taking. So our view is the pain trade is going to be cyclicals, potentially companies that benefit from inflation, not necessarily, growth, tech, Magnificent Seven, et cetera.
That hasn't worked yet. That's cyclicals. I mean, this has been sort of one of the challenges. No, that's not my point. But the reason why I highlight that is because it makes sense. If you get this recovery, the cyclicals should do well.
Right.
They should deliver on earnings. They should deliver on forward projections. They haven't all. They kind of portray this sort of uncertainty in this way that really is hinged on the lower and middle income consumer. Why will that change?
I think it changes. I mean, maybe it takes the election and moving past that uncertainty to get these juices flowing. But I think there is a lot of money that is sitting on corporate balance sheets or is waiting to be borrowed from banks on projects that are more must do than nice to do. I mean, if you think about it, infrastructure is super old in the US. Hasn't been a manufacturing cycle in a while. Now we're moving all this stuff back to the US. So companies want to spend money. They just don't know how to spend it. Should they spend it on EV, or should they spend it on, kind of, what's the lay of the land after the election? Are we going to be in a kind of a continuation of Biden's proposals, or are we going to see something very different? I think, though, the idea is as time goes by and we see inflation volatility, rates volatility moderate, which it already has, companies get a better handle on what's to come and start to spend money, and that unlooses the cyclical drivers. I just don't see the real, kind of drivers for a massive recession playing out. It would involve major job cuts across the board, and a lot of companies are still citing that the labor market is very tight. So unless we allow free immigration or something massive changes in the demographic landscape of the US, it's hard to argue we're going to see a real kind of wage disinflation or deflation environment. And then when you look at CPI and just supply constraints on kind of, commodities, on food, et cetera, we're still in an environment where I think that supply level of inflation is going to kick through and keep things stickier. I agree with your last guess. I think there is an argument to be made that inflation remains sticky and higher than what everyone's expecting and what the Fed is tethering their expectations to. And that's an environment where you actually want to own inflation-protected companies like cyclicals.
What about, to John's point, valuations? Some people saying that valuations are presenting the biggest challenge. How do you push back against that, given how much stocks have run up? We're, I believe, on the 27th record high as of yesterday this year.
We are, and record highs aren't that unusual. I mean, the market normally goes up, especially in inflationary environments. But look, here's the thing. I think the level today, we don't have as much conviction in the absolute index level moving higher. And the reason I say this is at the beginning of the year, there were many more bears than bulls on the market. Today, there are probably an equal split of bears and bulls. So the level of the index may be capped right around these levels, and we haven't upped our target to anything beyond 5,400. But I do think that the internals of the market present great risk. And the idea is, if you want to diversify your portfolio, you have to own something that's not working right now. And in my view, that's cyclicals, that's large cap value, that's where I have the highest conviction on a size and style basis. I think that in a few years, we'll look back on this moment as the moment you wanted to buy large cap value dividend yield. You heard it here first.
June 12th, 24.
We'll come back in 2 years and see where we are, but...
We'll see you before then. But we will clip this and we'll play it back. Savita, good to see you, as always. Thank you.
Great to see you.
Savita Subramanian there of Bank of America Global Research with a price target just 25 basis points north, 25 points north of where we are at the close yesterday.
Which is basically a sell-off compared to what we've been doing. I mean, I think that her point, though, about the internals is a really important one. Valuation is much more of a problem in a couple of stocks, not so much a problem in some of these other areas that have been left for dead in a way that defies the lack of recession that almost is the baseline for so many banks. This is, to me, one of the biggest debates. Is the consumer rolling over or normalizing? You've put this very well, time and time again. Basically, the wrong end of the telescope is chart crime, because you're not expanding the time frame long enough.
A welcome cooling or an unwelcome deterioration? Yeah. That debate's not going to be settled this morning, this afternoon, or at any point in the next week or so. Equity futures on the S&P positive here by 0.1%. Let's get you an update on stories elsewhere with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Apple shares soared more than 7% yesterday to close at a new record and trade back above their $3 trillion valuation. The market cap added was $215 billion. That's one of the biggest single-day gains by any company in history. That record came after the annual Worldwide Developers Conference, where Apple showcased a number of features related to AI. Former President Donald Trump met with several Bitcoin miners at Mar-a-Lago Tuesday night. That, according to the executive chairman of CleanSpark. Trump there told attendees that he loves and understands cryptocurrency. He said he'd be an advocate for miners if he retakes the White House. The former president has been increasingly highlighting crypto on the campaign trail in recent weeks. And is your GMT2 Rolex a Pepsi or a Batman? It makes all the difference in whether or not your watch is gaining or losing value. The red and blue Pepsi model rose about 4% to $21,000 over the past year. Meanwhile, the one you're looking at now, essentially the same watch, but in black and blue, aka the Batman, declined 10% to $16,000. That according to Subdial data. The Pepsi was the original bezel color when it was introduced in the 50s and is still one of the scarcest Rolexes. And that's your brief, John.
You've not heard of this before, Bramo? Heard of the Sprite?
No.
Like the green-coloured one? Personally, I wouldn't like an expensive watch named after a soda brand, but it's a thing.
Nostalgia. It's sort of very, very, very expensive nostalgia.
Childish nostalgia.
Yeah.
Okay.
You know, like socks that have Kit Kat on them.
There's some guys this morning looking at their watch as Bramo says that. There's this like childish nostalgia, and they've got that sort of green Rolex on their wrist. It's whimsy, apparently. Okay. See the valuations going down even more.
Stop.
Up next on the program, clamping down on China.
We should definitely avoid any kind of trade war, because a trade war is neither in the interest of the US, nor China, nor Europe, nor any country in the world. But nevertheless, we have an issue with the unfair trade practices.
We'll get the latest from the team here at Bloomberg. Ollie Krug, Mike Shepard on the other side from New York. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Getting trolled by Anne-Marie on Twitter. Just seeing that. You seen that? She's like sending pictures of food and the backdrop now.
And talking about how difficult her life is.
Okay,
and
yeah.
how we should feel sorry for her.
Super difficult assignment at the G7 in the south of Italy over the next couple of days. Okay. Equity futures on the S&P look like this. We're positive by 0.1%. Yields are lower by a basis point. The 10-year 439.42. About an hour and 12 minutes away from CPI in the US. Under surveillance this morning, clamping down on China.
We should definitely avoid any kind of trade war, because a trade war is neither in the interest of the US, nor China, nor Europe, nor any country in the world. But nevertheless, we have an issue with the unfair trade practices, with the high level of subsidies, and with the industrial overcapacities. I'm the Minister of Finance. I will spare no effort to defend our industrial interests.
So here's the latest. The European Commission announcing it's imposing additional tariffs on almost 40% of electric vehicles shipped from China. This coming as the Biden administration weighs more restrictions on China's access to chip technology used for AI. Our team coverage starts right now with Mike Shepard in Washington and Oliver Crook at the G7 meeting in Italy. Ollie, talk to us about how this sets the stage for the G7 later this week.
Yeah, Tom, John, I should say, this is the G7 meeting. It's all about multilateralism. It's all about getting along. It's all about sort of free trade. That is not the sentiment that you have coming into this now. Even the Biden administration with their Inflation Reduction Act, that has been a serious concern for a lot of the people here in Europe. And what happened to all those conversations about friendshoring? It's all gone to sort of onshoring. This has been the focus. So this is going to be sort of the internal tension within the G7. Where they want to try to unify is to get on the same page in their messaging around China and that industrial overcapacity. But John, when Biden wakes up and slaps 100% tariffs on Chinese EVs, where do they go? They go to the only market that can absorb it, that is Europe. And Europe started this probe 6 months ago. They're much slower moving. So we've seen this phenomenon across a range of different issues and different commodities and items. For example, solar panels, where the U.S. throws up trade barriers, and where does all that capacity go? It goes right here in Europe.
Before we get to you, Mike, Oliver, I do want to get your sense about how different what Europe's approach is right now to the United States. Essentially, they're not throwing up huge barriers. They're just saying in Europe, it's just going to be a little more expensive to give us a competitive edge. It's not the same kind of full of teeth effort that the United States is offering, correct?
Yeah, because there's also a lot more discussion within Europe, within the countries here, about kind of what they want to see. The French have been much more outspoken on, as we just heard from Bruno Le Maire, on China. The Germans take a much more cautious approach. I mean, the Germans and Olaf Scholz said, let's not forget that a lot of the cars that actually get shipped into Europe from China are actually European brands, or Tesla. It has that huge factory over in Shanghai. This hits these companies as well, to say nothing of the fact that many of the huge automakers here, specifically on their most high margin items, like let's say the Maybach and these kinds of cars, they're all produced here in Europe and they go to China. We have not had anything yet on retaliation, but I can tell you right now, having just spoken just moments ago with some of these major car makers in Germany, that is what they are anticipating, and they are now game planning the plan Bs and looking at their global production footprint.
Mike, to the point of what we were talking about earlier, which is a lot of the leaders that are coming to the G7 are coming from a really weakened position and are speaking about some of these highfalutin issues like Ukraine, like geopolitical cooperation, that are not reaching the voters. How is your sense that the Biden camp is going to try to message this going forward at a time where China is very much on the focus, where immigration is very much in focus, where populism is gaining speed?
And one of them will be at sessions like the G7 in Bari, Italy, where they will have to speak to leaders and try to find that degree of comedy and common ground where they can find a way to, for instance, stand against Russia's aggression in Ukraine and find ways to try to nip that in the bud. But they also have to message it back home with a little bit different tone, and that is where you see the messaging coming in much more forcefully on China and on the things that Oliver was talking about, too, this idea of onshoring, trying to build up the manufacturing base here in the U.S., where a move like that will resonate with voters who are looking for jobs and who are looking for sustained economic growth.
Mike, as you know, the president would have liked to have gone to the south of Italy to talk about leadership, multilateralism, the global order, the dark forces of nationalism in Europe rising once again, and stand shoulder to shoulder with people like Emmanuel Macron. He can't do that in quite the same way, can he, Michael, particularly after what we've seen in the elections over the weekend in Europe?
It's a much tougher position for him to take, and they're going to be looking for ways that they can at least find that little bit of common ground to maintain that unity. We are seeing the U.S. come out with efforts to curb Russia's access to the technology that it will need to produce the missiles that it's raining on Ukraine still. And they're going to try to message that more broadly with other G7 leaders that, look, we are trying to stand united. But it will be much more difficult with those leaders in Europe reeling on their back feet, really, after this week's elections.
Ollie, how do they recalibrate after that? Does Giorgia Meloni have a little bit more power after the weekend?
I mean, completely, John. I mean, this is really a referendum for a lot of people on sort of the national politics, right? And Giorgia Meloni is really the only person of the G7 that walked away with a sort of affirmed hand. So she comes completely in the spotlight, really just sort of now having the chance to host everybody here. And let's not forget, this isn't just the G7. There's something close to G14. We have people coming from, you know, the leaders of Turkey, the UAE, Brazil, Argentina. This is all coming together here to kind of be at Giorgia Meloni. And with Macron, who is basically, as we just saw a couple hours ago, basically running an election campaign, right, where he's basically touting the same things he's done in the past, saying that basically the center needs to hold. We have these sort of radical groups in France. The question is, will that work again? I mean, it worked the first time around, but it's part of the reason why they've done so well. He's weakened so fundamentally the two traditional pillars of French politics, of the Républicains and the Socialists, that now there is that void, and it's being filled by the National Front.
This is Meloni's G7 in a big way. Ollie, Shep, to the both of you, thank you. Our Bloomberg coverage on a very different approach to China coming out of Europe versus just, say, 100% tariffs coming out of the US a number of weeks ago.
Let's sit on this for a second. This idea of what the tariffs actually are. They're not a blanket tariff of about 25%. It's different depending on which auto manufacturer it's coming from in China. I'm trying to understand why Geely got 20% tariff versus BYD, which is 17.4%. I mean, how did they come up with these?
Tesla's in the mix as well, by the way. Some Teslas coming out of China into Europe.
Which then is a focus of debate, and there's some discussion over whether they're going to potentially amend some of the tariffs on Tesla. How do they calculate some of these? SAIC at 38.1%. Is it sort of, you know, you're particularly overproduced, you're going to get a particular tariff versus this one, versus what is a direct competition in Europe that could potentially be at risk if they slap a tariff on one company versus another? I mean, honestly, it just highlights the fissures, frankly, in the discussions around this.
I noticed how that conversation quickly went to Chinese retaliation. I think it's really important just to point out before we even begin to have that conversation, we were never talking about a level playing field here. I've got the numbers in front of me. The current charge on passenger car imports from Europe to China is 15% already. That's why so many manufacturers are in China. They made it very, very difficult to export into that country. So retaliation, I think maybe we're using that word a little bit too loosely.
The idea is, what if they get banned, especially at a time where Mercedes, for example, has about 40% of their business in China?
You can see why they're concerned.
Correct.
Sort of publicly on the record saying,
no.
we don't want this, don't go in this direction. Privately maybe saying something differently.
Correct.
Sure. From New York, this is Bloomberg.
world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
In about 60 minutes' time, we'll be talking about only one thing, CPI. It's just around the corner. The score's going into it. Look a little something like this on the S&P 500. Futures positive by 0.15%, on the Nasdaq up by 0.2. A little bit of a lift after closing at all-time highs in yesterday's session. Thank you, Apple. There was some underperformance, though, yesterday from the financials. And Lisa, I think that's notable.
Especially given some of the political risk that we've been talking about, given sort of the sympathy sell-off in the U.S. with Europe. I do want to point out that yesterday we got the 27th high, record high this year for the S&P, 15th record high on the Nasdaq. Apple, you were talking about, had its best day since November 2022. It added $215 billion to its market cap. How are we just sort of benumbed to some of these moves and how big they are? It's sort of everyday occurrences that we just don't even think about anymore.
It was kind of bizarre, given that we spent the whole morning talking about Apple, and Apple in the pre-market was barely moving. And then for some reason picked up and everyone started saying, yeah, it was after the launch. Everyone was really happy with the launch. On the day of the launch of AI, I think we were down by something like 2%.
It doesn't make sense. I mean, honestly, this doesn't sort of cohere, although people said, just wait. And maybe Dan Ives got out there, put on an even brighter outfit and said, just listen to me, just be a bull. It's worked. I mean, maybe, I don't know. But either way, the fact that it jumped so much and that we can sort of shrug it off like, well, yeah, this is what happens. It's bizarre. These moves are not normal. This is a new kind of, what some people would say is fragility in terms of how big the jumps are on a daily basis for some of the biggest names ever in the history of the United States capital markets.
They're closing out the first half with two very, very different stories for Apple. Struggled to start the year. As we finish the first half, it's kind of picking up, getting better. Dan Ives wins round one, I guess, against Tom Fordy of yesterday, who said, what did he say? He'd wear a green jacket.
He'd wear the most obnoxious,
and a hideous shirt.
He'd wear the most obnoxious, most colorful outfit in Dan Ives' wardrobe if there is some sort of increase.
I'm not sure Dan would use words like obnoxious and hideous, but yeah, sure.
When you looked at the New York Post article about how he's the
best dressed man on Wall Street,
there are comments like, when my wife says things like, I'm not going to let you out of the house looking like that, he views that as a compliment. And then he said, there's really no rhyme or reason to his wardrobe. He just picks stuff out.
So the more he upsets his wife, the better he thinks it is?
Yeah, like it works better for making him feel
It's an interesting
good.
approach to home life, isn't it?
Well, I mean, it's sort of the reality check of who I feel. Oh, really? We've all been there.
And then he knows that's a thumbs up, let's go.
Absolutely, 2 thumbs up.
I'm sure that resonates with a lot of men waking up this morning. Let's turn to the bond market, 2-year, 10-year, 30-year. Yields look like this on a 2-year. We're just about unchanged there. Let's call it 483. On a 10-year, down a basis point to 439. You've talked about it twice already this morning. Why not make it 3 times? Decent auction yesterday, 10-year. Went quite well.
Which is unusual. They've been going badly. And to me, I'm just wondering, is this basically people saying the whisper number for what we get in about an hour time is that it's going to be a softer CPI print than headline? Is this basically the baked-in disappointment or the baked-in positive downward surprise that we had before the labor market report that was completely incorrect? But is that sort of what people were sniffing out in what we saw yesterday?
I want to turn to the European markets just briefly. We'll talk more about what Macron had to say a little bit earlier this morning. But the French bond yield started to come in just a little bit. We're down by 3 basis points. Went through 320 yesterday. Spreads between France and Germany on a 10-year maturity, the widest of the year. Just spooked by the politics. maybe trying to undo just a little bit of that, but it's been a struggle over the last couple of days.
How do you undo the uncertainty that this has introduced and the fact that even people in Emmanuel Macron's own party are saying this was a mistake? Why are you opening up this government to rule from a more populist, more right-leaning branch? He's basically saying we're going to grow our way into this debt. Don't worry about it. I'm here. I've got your back. And as you pointed out, that's worth now 3 basis points.
3 basis points lower on a French 10-year. Under surveillance this morning, all eyes on today's doubleheader. CPI at 8:30, followed by the Fed rate decision at 2 p.m. The Fed widely expected to keep rates on hold, but there's less certainty over the so-called dot plot. So let's start with CPI. The estimates month over month for headline inflation, 0.1% in our survey. Stripping out food and energy, core, Lisa, 0.3 is the median estimate in our survey.
And what will be considered a bad read versus a good read? How big will the response be? And this is something that I know JP Morgan analysts have looked at, that you could see about a 1.5% swing up or down in equity markets on the heels of either a downward surprise or an upside surprise in CPI. Of course, all of this will be likely undone by the Fed news conference at 2:30 p.m. Eastern, when Jay Powell comes out and says we're still planning to cut. Don't worry, we got this.
There's a feeling, though, that this will set the tone for that decision, for the forecast, for that news conference. Do you not buy that?
You know, this has been a Fed that's been talking about how there's sort of more than 1 month of data needs to be really factored in. They're going to have this data probably yesterday, so they'll already be factoring that into some of their outlooks. I'm just wondering, you know, if they discount an increase in inflation, that will give you a sense of how dovish they're leaning. And if they really lean into some sort of disinflation, same, right? It will only be if they really just say we really haven't gotten the certainty yet, and it probably pushes it back a little bit later, then it'll get a reaction.
We know where the bias is currently, that's for sure. This story popping up this morning and over the weekend as well in a big way. French President Emmanuel Macron telling voters it is, quote, absurd to think he will resign before his term ends in 2027. Even if his party suffers in the snap elections, he's called for the end of the month. Macron's surprise decision to dissolve the lower house of French Parliament coming after his far-right opponent, Marine Le Pen, won big in the EU parliamentary election. And some people think it was absurd that he called snap elections, given that this was in line with the polls.
And other people saying that it actually is a brilliant way to get ahead of the no-confidence vote that was coming down the pike from a lot of the parliament members that might have undermined his ability to govern anyway, simply because it sort of ups the drama and sort of takes the onus off what he's done so far.
He, of course, doesn't get to run in 2027. The fear is that someone maybe a little bit looser with fiscal policy comes into power, which I would use the word absurd once again, because this is a man who's been a little bit loose with fiscal policy, even though he's in power.
But that's exactly what I was going to say. He's saying that they're going to grow into their debt load. This is what we hear everywhere. We've heard this for years. Guess what hasn't happened? We haven't grown into our debt yield because the debt load has increased at a much faster pace than what we have seen. My big question is, what's the fiscal response to a downturn in economic growth if you do have this deficit already? Which government official is going to say, actually, we can't help you, just suffer? I mean, that's not going to fly. So at a certain point, you have to wonder, what does this world look like as deficits go bigger?
Let's run with this theme. I've always said the cheat code to work out the difference between DM and EM is what happens when the economy goes south. In developed markets, you buy the sovereign. That's what you do. You see it time and time again in the US. That allows the fiscal authorities to be able to act counter-cyclically, so to speak, to respond to that. All kind of benefits the system. EM has a very different problem. Now, what we saw in Europe on the periphery, the likes of Italy, Greece, things went the wrong way, made things really, really hard to respond to economic downturns. France was sort of grouped in with Germany. We always considered them less of a hybrid, much more just a pure DM. If things go bad, yields go lower, the ECB cuts interest rates. Do you think we're closer to testing that for the likes of France? Because based on the price action we've seen over the last couple of days, there's some of the conclusions people are pointing to.
This is the reason why Steve Rasciuto is brilliant. He was talking about how there is a credibility issue here for the Federal Reserve that has come with not fighting the fiscal impulse that dramatically. Because at this point, there is a question of what happens in that type of scenario. Does the Fed essentially monetize a greater fiscal impulse? In other words, do they buy an even bigger amount of bonds to finance and essentially just cancel out any debt so that you can still stimulate the economy? You just put all this together. And it's the reason why there's a lot of anxiety underpinning what otherwise, on the surface, morning to evening, looks like a pretty confused and otherwise totally fine market.
Lots of elections. making it even more confusing. Let's put it that way. PIMCO with a big warning overnight of more regional bank failures in the United States as a result of a, quote, very high concentration of commercial real estate loans. This as one New York City office building is said to be sold at a 67% discount from its 2018 purchase price. Winnie Caesar of Credit Sites writing this: the bigger challenge of banking exposure to CRE is in the tail. Many of the regional banks have an outsized concentration of CRE exposure. This leaves smaller banks with less cushion to absorb default losses from CRE. However, it does help with systemic risk concerns. Winnie joins us now for more. Winnie, good morning to you.
Good morning.
It's good to see you in person around the table. It's an important conversation. Lisa, I think earlier on this morning, nailed it. We have to separate systemic risk from just the prospect of banks failing. Banks can fail, and you can't have the other. Like, that can happen. We saw that last spring. Can you walk me through what's on the table with CRE going into 25 and going through the rest of this year?
So with CRE, I think that the biggest thing that we miss sometimes is CRE is not one homogeneous asset class. There's a lot of different things in there. And when we're thinking about the concerns in CRE, it's a very specific type of really office property. And so that's an even smaller amount of exposure. So yes, there's absolutely going to be losses in CRE over the next probably 2 to 3 years, perhaps even longer than that, depending on how long we stay at these elevated rates, how long occupancy rates stay low. But the big positive is we haven't had this massive over-construction build. Bank balance sheets are not over-leveraged to construction loans, development loans, and that's usually where you see the biggest losses. So there's absolutely going to be some issues within the banking system, but banks have been very proactive in trying to reserve for that. And the banks with more exposure to office properties especially have been reserving at a very rapid pace that's kind of outpaced the challenges within that sector.
I know a lot of people don't like comparing these things to baseball games, but let's just go there in terms of what inning we're in terms of some of the real estate re-reckoning that a lot of people are warning about. When it comes to commercial real estate, where are we?
That's a great question because it feels like the first few innings of this baseball analogy were no hitters, right? They were just kind of fast and furious. We really hiked rates. We haven't seen a lot in terms of transactions to get a good idea of like where property values are. And now I think the game's going to slow down a little bit. And we're probably in already the 5th inning or so, but I think that the first few innings were played faster than the remainder of the game, and now it's going to be a little bit of a slow play.
What do you make of the theory that when the Fed cuts rates, that's when you're going to really see things be borne out in the market, when you're going to see people solidify losses? All those people who, and I'm not just talking about commercial real estate, but also residential, people who've been locked into their homes will actually go out and sell their homes, albeit at lower valuations. Do you see that as likely, the idea that there will be more of a reckoning when rates come down?
I think that if rates were to come down dramatically, right, if we're going from 5.5% to 2% in a 6-month period, absolutely, there's going to be a reckoning because that would indicate that some sort of massive recessionary force has resulted in disinflation and the Fed is now chasing things lower. Our expectation is that it's going to be a much slower game in terms of Fed rate cuts in general. And that, I think, would be a little bit of a slower play of the kind of reckoning of asset valuations in real property.
We caught up with Bank of America this hour, who basically said we're looking at the wrong thing. And I'm sort of paraphrasing here. We shouldn't be focused on a building on 44th Street in Midtown West. We should be sort of zooming out. What did she say, 50-year trend line or something like that?
Exactly.
Apparently we're in a great spot. Is that why credit spreads are as tight as they are and valuations and equities are as high as they are too?
Yeah, I think there's a number of factors that are supporting valuations. The first is the cash on the sidelines. That's still a dynamic. It's being recycled out into other asset classes because that cash on the sidelines is throwing off an awful lot of interest that needs to get reinvested. The reality is we've gone through a pretty significant deleveraging cycle as it relates to the consumer, as it relates to bank lending, and that is just going to result in putting cash to work in other places, right? If we are not over-leveraged, then there's just more cash that needs to be deployed.
Can I just pick up on a point that you just mentioned? Are you saying that higher rates are one of the reasons that credit spreads are so tight?
Absolutely. There's the push and pull between the spread buyers and the yield buyers. The yield buyers are winning, right? Anytime you see a backup in yields, a little bit of widening in spreads, people get back in because they say, hey, investment grade at 5.5%, 6%, historically, that's a home run. High yield at 8%, historically, that's a great bet. And you've also seen the higher rates shift the fundamental direction of management teams. They don't want to be over-leveraging their balance sheets. They don't want to be doing massive M&A.
So you like duration now, though, more than credit, which is the opposite of what you've been saying for quite a bit. What caused you to shift?
So I think that in the near term, we're looking for a little bit of volatility on the credit side of things as the adjustment to expecting rates to be a little bit higher for a little bit longer hasn't really played through in those highly leveraged, lower rated capital structures in the broadly syndicated loan market as well. In the IG market, we still like taking credit risk. We're fine going down to double Bs, even in the high yield market. But duration here looks really attractive for kind of the first time in a long time. We've been saying if the 10-year treasury is north of 4.25%, 4.5%, you should be extending duration in your portfolio.
Winnie, this was great. Awesome to catch up.
Thank
to
you.
break down CRE and the broader credit market at the moment. Winnie Caesar there of Credit Side. So let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Paramount chair Sherry Redstone has walked away from an offer to merge her family's media company with David Ellison of Skydance. It ends months of drama and tense negotiations. Redstone had been pushing for a merger with Skydance over other offers, a deal that she believed would be in the best interest of her family and company legacy. Yet she saw months of resistance from management and shareholders, which forced Ellison to revise his offer. But now Redstone has changed her mind. With more than $14 billion in debt and a struggle to compete on streaming, it is unlikely that Paramount can stay independent. The EU has notified Chinese automakers of an additional round of tariffs on EV imports. The European Commission says that they will range from 17% for BYD to 38% for some other automakers, basically making a clarification on whether they're cooperative or not. They're expected to go into effect next month. The higher rates will also hit Western car makers like Tesla, who export their cars from China to Europe, though the Commission said that Tesla may get its own rate. China has already signaled that it's ready to make moves against them, threatening measures across agriculture, aviation, and cars with large engines. BlackRock CEO Larry Fink and Microsoft CEO Satya Nadella are among business leaders heading to Italy for the G7 summit this week. Co-hosted by President Biden and Italian Prime Minister Giorgia Meloni, they will support Italy's push to invest in developing countries. Microsoft and BlackRock declined to comment when Bloomberg reached out. And that's your brief. John.
Danny, thank you. That's an odd one, isn't it? Why would you decline to comment? Going to see them there.
Well, it depends on why they're there and who they're discussing things with. And I'm surprised Elon Musk isn't there, basically saying, really? You're going to tariff me?
Where's my carve-out?
Yeah, exactly. Excuse me, I'm American.
Danny implied there would be a carve-out. We'll see, I guess. Up next on the program, mega forces at work.
The mega cap trend, again, not necessarily just 2 or 3 companies, but those companies that are exposed to these longer-term secular trends like AI, like internet commerce, like cloud computing, they have further to go.
That conversation up next, live from New York. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
CPI data 42 minutes away. Equities look like this on the S&P 500. Record highs yesterday, this morning, up another tenth. In the bond market, yields are lower by a single basis point, 439.22. That can all change at 8:30 Eastern time when we get CPI data. Under surveillance this morning, mega forces at work.
The mega cap trend, again, not necessarily just 2 or 3 companies, but those companies that are exposed to these longer term secular trends like AI, like internet commerce, like cloud computing, they have further to go. It is an example of investors looking beyond 2, 3, 4, 5 companies and thinking about what are the other beneficiaries of this AI revolution.
So here's the latest. Apple's AI surge driving the S&P 500 to a fresh all-time high as investors turn their attention to a double dose of CPI and a Fed rate decision. Citi's Scott Croner writing this. The market appears to be pricing a first Fed cut in December. Citi's economists have confidence in a September cut predicated on decelerating macros. All told, the S&P 500 continues to be influenced by the structural growth opportunity in generative AI as an offset to the mixed macro picture. Scott's with us now for more. Scott, I'm going to say it for you because you won't do single names on TV. But is this just another way of saying ignore the Fed and buy NVIDIA?
I think it's another way of saying that Wall Street's much different than Main Street, and the Fed's influence is mainly a Main Street issue in terms of the economic activity that underscores, U.S. equity fundamentals.
We've heard it a million times that the equity market is not the economy. Is this S&P 500 in its current form a pretty good example of that?
So we've done some what we call sanity check work on this, and if earnings solely follow GDP over time, our back of the envelope is that the S&P would be worth 4,600, okay? So what you're paying in current levels, 53 and above, is going to tell you at some level what you're paying for the expectation for growth over and above economic activity. And clearly this is being influenced by the mega cap component and the AI tailwind that it now has. What it basically says is that for those that think, my gosh, we're in an equity market bubble, I'd say, well, your downside is probably 15% in that regard. And when you step back and look at it with the new growth driver that we do have regarding spending on AI and other metrics around that, the S&P is actually in a pretty good fundamental place.
We've been joking, Scott, that the best bet right now, or the bet that everybody comes on and says, is they're having cashed NVIDIA, and that's essentially the barbell approach that they've been taking, or basically tech and big tech stocks that are generating a lot of cash, and then cash itself. And that's the approach to take in a macroeconomic environment that is highly uncertain. How concerned are you about this type of behavior leading to real crowding in a specific number of stocks?
Lisa, I think it's a really good point. We're obviously very concerned about crowding, but what I would say so far is that you look at valuations, got it, but when you look at PEG ratios, which is your PE over growth, it turns out that your PEG ratios have actually come down. So what's been happening is that the underlying earnings expectations for these mega cap growers have actually been supporting the price action and the valuations. Now, to your earlier point, though, whether you want to call it a joke, but I think it's reality, is that you're right. What you have is a Fed policy circumstance that is at risk of unintended consequences. So on Main Street, if you're a non-saver, you've got issues. You've got higher inflation that presumably is coming down now, and now higher interest rates. That's a much different setup than if you're a saver and you're now earning a decent return on your cash, which is much different than prior to COVID. It's the same thing in corporate America. So the mega cap growth tech part of the market does tend to carry lower debt, more cash. That's a market different discussion from looking at sectors like commercial real estate or real estate and utilities, staples, parts of industrials, where they do tend to be more debt laden. So the fact here is that the Fed, whether it's intended or not, is providing a different type of headwind and tailwind to different parts of the economy and different parts of the stock market.
If the Fed were to start cutting rates, would that make you more constructive on these other areas, or would it kind of depend?
It kind of depends. So the other work that we've done recently basically says if you were to cut 200 basis points of Fed rates over the next year, that would create, all things equal, a roughly 1.7% earnings drag on the S&P 500. Essentially, those mega cap growth companies would lose would lose more in their cash income than they would in what they pay on their debt. So, it's a bit of a circuitous argument on this, but as you go down cap, as you go down into small mid cap, this is where now you begin to trade more aligned with the underlying economy. You don't have that mega cap influence in small mid almost by definition or implication. You've got a lesser tech weight, you've got higher industrials exposure, you're more economically sensitive. At the margin, small mid cap would benefit from a rate shift. But the perspective here is that historically, when we've gone into more prolonged periods of Fed ease, it's usually been on the other side of recession. And during those recessions, you tend to have a major drawdown in earnings. We don't think we're looking at that right now. So it is a more mixed picture this time, Lisa.
Scott, before you go, I just wanted to mention the Pulse Monitor that you and the team put out and pick out the S. An opportunity, of course, to talk about the late, great Tobias Lefkovich as well. Can you talk to us about where sentiment is right now, Scott? Because it feels like on this program, 1 minute everyone's bearish, the next minute they're super bullish, and it changes day to day. Where are we?
Well, our sentiment read, we're in euphoria. We've been there for a couple of weeks now. We've been in and out, right? So we went clearly into euphoria at the end of Q1. We had that April pullback, pulled us back out of euphoria. Now we're back in. The way we're spinning it around, John, is that we're focused a bit more on your cross-asset valuation work, which off of this recent rally, what it has done is begun to switch the cross-asset valuation a little bit more in favor of bonds. And so the combination of that, where we're trading versus our estimates of fair value for the S&P and the Lefkovich index, all suggest to us that we're looking at a market that's due for a bit of a digestion in here, but that's a different discussion than the longer-term fundamental setup, which we still think looks pretty good.
Scott, you're one of the best. Appreciate your time this morning. Thank you, sir. Scott Cronert there of Citi. Some more from Citi this morning. Andrew Honhorst just publishing moments ago. Median dot showing 225 basis point cuts, and Powell emphasizing the rise in the unemployment rate and drop in job openings would emphasize the dovish message that the team at Citi are looking for in this press conference.
Well, he has been talking about, Andrew Hollenhorst and the team has been talking about the fact that even though they're pushing back their first cut expectation to September from July, they still kind of expect the same framework and the Fed to respond to it in that way. Isn't this kind of what everybody's expecting today?
We'll see. We'll see what other people say in the next hour after we get CPI at 8:30 in about 35 minutes.
What did you call it, the losing game?
It is a losing game.
Yeah, I know.
Things can change. You want to talk about the dot plot? We'll talk to a man that hates it much more than you do.
I can't wait.
The former St. Louis Fed President, Jim Bullard's going to join us in just a moment. The perfect setup for inflation and Fed Day, alongside Bloomberg's Ira Jersey and Francis Donald of Manulife. All of that coming up from New York City this morning. Good morning.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
We see that trends in inflation are exactly where the Fed wants it to be.
It's going to be very difficult for policymakers to get excited about a rate cut unless CPI actually is decent.
One message you're going to get from Chair Powell, this is not about the year-over-year rate of change in inflation, it's the sequential monthly pace.
If you get a 0.2, then it's a reasonable conversation to have about a July cut.
Fed cuts, preemptive cuts, are essential for the soft landing to continue. If inflation doesn't let them do that, I think then we're looking at a bigger slowdown.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
In many ways, this is like the Super Bowl. It will last about 6 hours. 8:30, you get CPI. 6 hours later, you'll have a Fed decision, some projections, and the news conference starts with Chairman Powell. Starts 8:30 Eastern Time.
So who does the halftime show? Come on.
We do. It's us.
Here we go. Hi.
TK's the entertainment.
Right.
He's going to sing.
It's going to be fun. Really?
Yeah, Tom's going to sing, he promised.
He brought his guitar in?
He's brought his guitar in. We're going to get a little sing-song around the table.
It's going to be a fake bonfire in the middle.
Nice reunion. It'll last about 2 hours. Then we'll do it all over again at the next meeting.
It'll be fantastic, honestly. This is actually a pivotal moment because a lot of people have been basically trying to understand whether the weakness is the correct way to read the recent data or whether the strength is the correct way to read the data. And ultimately, it just depends on what the Fed thinks. And if the Fed thinks it's the weakness, well, how much does that shift where we are in markets
It's
right now?
rare to see this on the same day, to have inflation data, then in the afternoon have a Fed decision. And there are many people out there that believe the number we're about to see in 29 minutes will shape the projections we get at 2 p.m. and the tone of the news conference from Chairman Powell at 2:30. We'll see, but that's a view on Wall Street at the moment.
It's difficult to sort of understand because they say that there has to be a cumulative number of data points. Nonetheless, we are looking at CPI. The last time that this happened, that we got the CPI print on the same day as a Fed decision, was June of 2020. That is how long ago this has happened. It is a rare occurrence. Granted, they probably got the data yesterday, but it just highlights how whipsawed the market could become. First is the shot, and then the chaser, the Fed's response to the shot.
Shot and chaser a little bit later. Equity futures on the S&P 500 positive by 0.1%. These are the scores going into that inflation data. Yields almost unchanged, down about a basis point. The 10-year 439.42. Lots to talk about on the euro side of the trade and the dollar side of the trade. Euro dollar 107.63, trying to bounce after some euro weakness over the previous 2 days. Macron says he is not resigning, and maybe that's worth 0.2% on euro dollar.
What this has all highlighted to me, and this week actually has been fascinating from this point of view, which is political risk and how it has had a huge influence on markets, even though people can't predict it and can't prepare for it. What we've seen in French banks, holy cow, their shares have dropped out of bed, 11% decline since Friday when you take a look at Société Générale in France. So when you take a look at some of the moves, you wonder how exposed are we to other risks, and how does the Fed kind of deal with that, given that policy does have an effect on growth, on inflation, on all the things that they're trying to prepare for.
Bit of weakness in US banks as well yesterday, even though we did see those tech-driven all-time highs once again on the S&P and on the NASDAQ. Beneath the surface, financials were really weak, looking at Citi and the likes of JP Morgan. Coming up this hour, we'll catch up with the former St. Louis Fed President, Jim Bullard, ahead of a CPI print and Fed rate decision. Bloomberg's Ira Jersey, as some bond traders abandoned bets on a Fed day rally, and Francis Donald of Manulife reacting to the latest inflation print. We begin with our top story. CPI is about 26 minutes away. That inflation print coming as the FOMC's two-day meeting comes to a close, likely determining what the dot plot looks like going forward. The former St. Louis Fed President, Jim Bullard, saying he only sees 1 or 2 cuts on the table this year thanks to slow progress on inflation. Jim is with us here in New York. Jim, good morning to you.
Good morning, good morning.
Just fantastic to see you, sir. I want to talk about your dot plot from a long time ago. We all remember when it came out years ago, and you said enough of this. You put your dot right at the bottom and left it there for the next couple of years. How do you approach the dot plot, and how do you think these officials would approach it today?
Yeah, I mean, at that time, I wanted to get the idea across that we had just switched to a low interest rate, low inflation regime, and that we were unlikely to break out of that regime anytime soon. And so it was probably a better forecast just to say that you're going to stay in the regime. Now that the pandemic came along and upended the global macroeconomy, it looks like we're in a different regime now. So maybe it would be a different dot today.
Well, let's play it. Do you think it would be post-GFC in reverse? Would you just leave it up there at 550 for a couple of years out?
I think that's a little high. I'd like to see the yield curve normalize here as the final piece of the soft landing. But I do think yields will be higher going forward than anything we saw between 2009 and 2019.
Do you think that the Fed is accurately reflecting that in their current projections?
That rates will be higher for longer? They've got their long-run dot at 2.6. Maybe that'll shift up a little today. I think the idea that you're going to have that low of a policy rate, I don't know, that's getting a harder story to tell, I think.
Well, so Steve Raschuto was on earlier, and he said essentially there's a real test of the Fed's credibility right now at a time where some people are saying that we're essentially going to vacillate between 2 and 3% in terms of inflation, or even stay at 3%, given the Fed's proclivity to cut rates in the near term. Do you agree with that, that essentially this is a 3% inflation target that just hasn't been enunciated by the Fed?
No, the target is 2%, and if inflation stays above 2%, then policy has to be at least mildly restrictive to try to push inflation back to 2% over a reasonable time horizon. But a key thing is what time horizon do you think it should take to get inflation back to target? And if you look at these projections, they're probably talking 2 years or something like that. So you got 80 basis points to go on core PC inflation. You could do 40 basis points in 1 year, 40 basis points in next year. And so it's not the urgency that we had when inflation was much higher just 2 years ago.
Jim, when you're putting together these forecasts, how much collaboration is there on the FOMC? Do you all go off into a corner and just sort of plot it down? Do you do it ahead of time?
That's pretty much what it is. I have actually tried to call around to my colleagues and stuff, but it's very time-consuming to call everybody, and they've got their own staffs and their own stories to tell, so it works better just to give your own view. And so there's a lot of communication by osmosis too. You kind of know what everybody's saying because you see them all the time and you hear their speeches and everything.
Because we heard from someone yesterday that kind of implied, basically said, that for the Federal Reserve it would be better if the implied cuts this year, the median dot for 24, came down from 3 to 2 and not down to 1. And Lisa and I were basically saying to that individual, well, what are you talking about? You're telling me that Chairman Powell's going to get on the phone and say, look, guys, we need to massage this and collaborate and make sure the median dot just shows 2 cuts for this year and not 1. That's not how it works, is it?
No, and people have strong views, so I don't think, they take their role very seriously on the committee, and they're not really willing to say, I'm going to compromise my view just because of, something that might happen on that particular day.
Yeah, but this does raise this question of how do you message it perfectly? Is there true consensus? And what's the differential between consensus view and, I dare say, groupthink or something where people all sort of are coalescing around this idea that inflation is maybe a little bit higher, but not that much higher, that rates are restrictive, even though the economy keeps chugging along?
Yeah, I think one thing to keep in mind about this is that the board staff serves the whole Board of Governors, so they kind of have this, they all see the same analysis and the same, have the same projection, and then they may have a view relative to what the staff presents, and then they might deviate a little bit, but they don't have their own independent staff, whereas at the banks, all the banks have their own research teams, and they might have very different views from what the board staff thinks. So, the tendency for some of the dots to be clustered would be at the Board of Governors.
You were on the Fed in 2020 when you were dealing with some of these issues, and that was the last time that we had a CPI print the same day as a Fed decision.
Yeah, it's like a solar eclipse or something.
Yeah, this is so we're staring into the sun, the political sun, and it's a solar eclipse. You're here for us. How much does it really alter the discussion?
Yeah, I think I would just caution viewers here and listeners that what happens is on this day of the meeting, this meeting will start at 9 o'clock this morning, the first thing that will happen is that the staff will come out and say, here's what the CPI report said. And most people will know the number, at least the headline number at that point, but they'll give a brief analysis of that. But the only thing that will matter is it different from what the staff forecast? So did it come in hotter or colder than the staff forecast? If it came in about as expected, then the staff will say, well, this didn't change anything because we already expected this. So usually it's not big news at the committee. There would have to be some blowout difference.
Do you think that it is correct that the balance of risks between inflation and a slowdown in growth is roughly balanced? Or do you think that it's more heavily weighted to one than the other?
Well, inflation's been high, and I think we want to finish the job here and get inflation back to target. So I think that's still job one. And labor market seems pretty strong based on the jobs report, last Friday, and other aspects of the economy seem pretty good. Atlanta Fed GDP now for the second quarter up over 3% at an annual rate. So
changes daily.
It does, but I think if you're just tracking and just trying to make a statement based on the data that you have in hand right now, growth looks pretty good, labor market looks pretty good, inflation's still too high, might as well stay a little bit hawkish.
Jim, I've never seen people so skeptical of a 272 on payrolls as they were on Friday. Can you walk me through how you interpreted that economic data, both on the establishment survey and a household survey, and how you'd read into that? Because when you say maybe we need to be hawkish today, some people think based on that number Friday we should be dovish. I mean, how would you interpret that economic data?
Yeah, unemployment ticked up to 4%, and that's interesting, but it's still below pretty much everyone's estimate of the natural rate of unemployment. So they've been saying that, we've been saying at the Fed that, unemployment should probably be expected to run a little bit higher than it has, and low fours or mid fours on the unemployment rate is a very good number still for the U.S. So, and then on the headline number, I was just thinking about this, so I plotted something that no one ever plots, which is the percent change year over year in non-farm payrolls. So if you look at that, a year ago you would have been at 2.5% growth year over year. Now you're at 1 3/4 year over year. So that does show the slowdown, but the 1 3/4 would still be faster than So if you took that to be the run rate, we always go on the monthly number, which is so volatile, and how are we supposed to interpret this? But other measures of the economy will go on the year-over-year rate, and that controls a little better for seasonality and stuff like that.
We're lucky we've got you for the hour. Jim Bullard's going to be sticking with us for the next 45 minutes or so, working through that CPI data at 8:30 Eastern Time. Equity futures right now on the S&P near session highs up by 0.15%. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. The EU has notified Chinese automakers of an additional round of tariffs on EV imports. The European Commission says that they will range from 17% for BYD to 38% for some other automakers and are expected to go into effect next month. The higher rates will also hit Western car makers like Tesla, who export their cars from China to Europe. Just moments ago, Volkswagen responded to the decision, saying that the negative effects outweigh potential benefits and that the timing is detrimental to currently weak EV demand. Elsewhere in Europe, French President Emmanuel Macron is calling on moderates to regroup to defeat the far right after Marine Le Pen's party won big in the EU parliamentary election. Macron addressed voters this morning for the first time since calling for a snap election. He said it is, quote, absurd to think that he will resign before his term ends in 2027. Meanwhile, yesterday, the French finance minister Bruno Le Maire said that if the far right wins, quote, a debt crisis is possible in France, a Liz Truss scenario is possible. Mexico's President-elect Claudia Sheinbaum attempted to ease investors' concerns, perhaps unsuccessfully. The peso weaker by another nearly 1.5% versus the dollar this morning. Sheinbaum spoke on Tuesday after her ruling party's landslide election win, which had sparked fear over unchecked reforms. Speaking at a news conference, she said, quote, investors don't have any reason to worry, and added that the economy was stable. The currency is down now more than 10% versus the dollar since the June 2nd vote, by far the world's worst performer over that period. And that's your brief, John.
Danny, thanks for that. So just imagine this, the French finance minister, like the sitting finance minister, saying that a Liz Truss moment is possible.
Yeah, that's a problem. That's a problem from a host of reasons, because you kind of aren't really raising any credibility in your currency, and in, well, I guess currency is shared currency, but in your bond market, which is what you see it. I feel like Liz Truss moment has to be codified in some way. Have like a little ghost.
Like across the screen?
Yeah, across the screen.
You want an emoji, something like that.
This could be used more and more.
Did weigh on the currency for what it's worth too.
There you go.
Euro trying to bounce, 107.65. Up next on the programme, the Morning Calls Plus. Ira Jersey of Bloomberg Intelligence as bond traders unwind bets for a Fed day rally. The conversation is next from New York. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
many ways, the week begins in about 13 minutes, 8:30. CPI data, it is just around the corner. Equity futures on the S&P 500 positive here by 0.15%. Let's get you some morning calls. First up, Piper Sandler raising its price target on Oracle to $150. The firm highlighting its $12.5 billion in new AI contract signings, reaffirming Oracle's ability to capitalize on the generative AI wave. That stock is up by more than 7%. Next up, Citi raising its price target on Uber to 96. The analyst noting increasing use cases for Uber globally, maintaining the rideshare company as one of its top internet sector picks. That stock is firmer by 0.9%. And finally, Loop Capital lowering its price target on Paramount to $8. The analyst citing the end of merger talks with Skydance, now expecting no transaction or takeover of any kind as the most likely scenario for the media giant. We're down there in the pre-market by 2.8%. CPI is the main event. It's just around the corner. Bond traders abandoning bets for a rally as today's double risk event kicks off in about 12 minutes' time. Ira Jersey of Bloomberg Intelligence joins us now for more. Ira, Deutsche Bank's Alan Ruskin has been counting the meetings. We've had 5 consecutive meetings, Fed Day rallies at the front end of the yield curve. Ira, does that end today?
Well, it could, although I suspect that the Fed is going to be, probably a little bit more middle of the road than maybe some others think. People do expect the dot plot to only show 2 cuts for the rest of the year instead of 3. That seems to be the growing consensus at this point. But quite frankly, I think that the bond market and 2-year yields, 3-year notes, they're going to be concentrated more on what the Fed says for 2025. So will the Federal Reserve be, somewhat more hawkish and maybe price out a lower terminal rate and therefore, maybe roil the front end of the market a little bit? So like you say, it's possible that we sell off by day's end, especially if they are a little bit more hawkish than people think.
I will build on that a little bit more. It's something we heard from Steve Rasciuto of Mizuho as well, that 2024 isn't the most important thing here. They could go from 3 to 2, maybe even to 1, but ultimately, he said, they'll just push that out to 2025. Is that what you're anticipating too?
Well, I do think that when you look at the preponderance of the data, it does seem like things are slowing, but they're not disastrous at this point. So if a lot of members of the Federal Reserve and the current members of the Board of Governors push up their longer term dots, right? So 2025, 26, and even that longer run is probably a little bit less important. But you think about the path of the Fed. So what we've seen over the last couple of months is we keep on pushing out when the Fed's going to start, but ultimately the terminal rate has also moved up, right? We went from thinking that the Fed was going to cut all the way down to 3% by 2026, and now that's come up, almost 100 basis points now. And if that's the case, then you kind of do have to reprice the rest of the curve because, especially if the market thinks that that's going to be realized. Of course, the Fed's dots are almost never realized, and I think that that's something that we have to get into the back of our head is that, that's their forecast, and they're just as good or bad at forecasting as just about everybody else. So, will the market believe that the dots are going to be realized? And I think that that's where you can create some volatility. I do think that they'll probably move those dots up a little bit, and I think that that's the reason why you might think that we'll get a little bit of a sell-off potentially, at least at 2 o'clock. Now, Jay Powell can reverse that by being more dovish during the press conference, of course, and that's why we always have these double whammy days on at end of the Fed day.
So, Ira, you like auctions, right? You like bond auctions. Were you watching yesterday's 10-year bond auction?
Absolutely.
Okay, so what was your interpretation of the strength there? Was it because there sort of was this feeling that maybe the CPI number would come in softer than expected, a greater disinflation than maybe is currently the consensus?
Well, I thought at first when I first saw that the number was very strong, that maybe dealers had set up pretty effectively for the auction, thinking that people would, that end users, so those are indirect investors, when you look at the auction statistics, would stay away because it was right before both CPI and the Fed. Instead, you actually had indirects came in had very strong demand. So end users, I think, might have been a little bit maybe underweight duration or short, in yield curve steepeners by selling 10-year notes, and they used the liquidity event that is was a bond auction or a note auction, as in the case of yesterday, and to basically cover those positions before the Fed. And I think it was a little bit surprising that the market seemed to have been leaning a bit short, and that you had that cover during the auction. But it certainly was one of the strongest auctions of the cycle. In fact, I think there was only one bond auction basically in early 2022 that was even close to being this strong.
Pretty solid. Ira, thank you. Ira Jersey of Bloomberg Intelligence. The biggest difference, of course, between our forecast and their forecast is that their forecasts have big consequences sometimes, and whatever I think about the future kind of doesn't.
Well, and they haven't been right for a lot of this, but they were actually more right about this year than the market was. And we have to keep reminding people of that because they kind of, you know, it's sort of running in place. It feels like that's what we've been doing in the market as we play this losing game. It's a great analogy. It makes me feel full of value. But there's this point going forward about, you know, they've actually kind of been projecting not that many cuts, and that's kind of what's coming to fruition.
Former St. Louis Fed President Jim Bullard around the table with us. Jim, Bill Dudley, former colleague of yours, and I'm sure a friend as well, wrote for Bloomberg Opinion in the last week that the Fed thinks it's fighting inflation. Think again. Even at more than 5.25%, the central bank's short-term interest rate target might not be high enough to cool the economy. If that was presented at the committee today, I can present it to you right now. How do you respond to that?
No, I think the committee is restrictive, and they do a lot of analysis on this. And I think the balance of the evidence is that that this is a pretty high interest rate for this economy. You know, you can make arguments around it, and there are uncertainties around it, but I think they've looked at that 6 ways from Sunday, and so I think they think they're pretty much restrictive here.
You have a lot of people who will argue.
No, I'll say this. I'll say
ahead.
this about restrictiveness. If you think that last summer was the right number for the policy rate, 5 3/8, and then core PCE inflation comes down 200 basis points during the fall, how can 5 3/8 still be the right number with only 80 basis points to go to get to the 2% target? So that's a basic argument, I think, for that it's pretty restrictive.
Some people would argue that it isn't because of the Fed funds rate that inflation has come down. It's different supply side responses. It's the supply side shock when it comes to even the labor force. And it raises this question, first of all, do you agree with that? But second of all, how big of an impulse would it be to the economy then if the Fed lowered rates, if companies have been able to get credit, and if, frankly, the economy is doing just fine in terms of the current rate regime?
No, the inflation came down because of Fed credibility, and it was really the moves in 2022, especially the 4 75 basis point moves in a row. The Jackson Hole speech, 8 or 9 minutes, all it said was we're going to get inflation back to target. It's that and the subsequent moves after that that convinced markets that the Fed was serious about the 2% target. And there was a moment in the spring of 2022 where that was slipping away, that the confidence in the Fed was slipping away, but that definitely reestablished that confidence. And it paid handsome dividends in 2023 when inflation came down dramatically. So now we're in a situation where, you know, core PCE inflation on a 12-month basis, Dallas Fed trim mean 12-month basis, those are all below 3% and hopefully heading lower. And so I think it's been a really successful policy, and it's all about the Fed.
There's the music. It's all about the Fed. It's all about CPI. Up next, 5 minutes away. The scores. Equity futures positive by 0.1% on the S&P 500. We'll break down CPI with Michael McKee as we kick off a doubleheader. CPI before the Federal Reserve this afternoon. We'll catch up with Jim and Manulife's Francis Donald. All of that on the other side from New York City. This is Bloomberg.
of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
The whole trading week has been building up to this. CPI data due in about 20 seconds' time. Equity futures on the S&P 500 going into that data positive by 0.1%. Similar move on the Nasdaq, up by 0.15. The scores in the bond market, 2-year, 10-year, 30-year, look like this. Yields lower by a single basis point. The front end of the curve at 482.13. With the economic data, here's Mike McKee. Good morning, Michael.
Good morning, John. It looks like further additional progress for the Fed. We'll have to get the data from Jay Powell later, but the CPI comes in up at not at all, flat for the headline number. The forecast was for a 1/10. That's after 3/10 last month. The core comes in up 0.2, which is lower than the 0.3 that was anticipated. That puts the year-over-year numbers at 3.3% for the headline, down 1/10 from 3.4 last month, and 3.4% for the core on a year-over-year basis. That's 0.2 lower than 3.6 last month. So all in all, the headline numbers are pretty good. Let's take a look at what we're seeing in terms of some of the major categories here. Food up just 1/10. Food at home, which has been sort of a campaign issue out there, 0.0. So flat for food. For energy, energy overall down 2%. Gasoline prices down 3.6%. And natural gas down 0.8%. So good news there. New cars prices down 0.5%. A lot of focus on used cars, which were up 0.6%. But new cars have double the weighting in the CPI of used cars. So that's a significant drop. Motor vehicle insurance, which has been rising and has been huge, goes down 0.1%. And then for shelter, up 0.4%. Rent of primary residence up 0.4. No change there. Owner's equivalent rent up 0.4. So the rent sides stay about where they have been for the last few months. No real progress there. The one thing I will say is if you look back to what Chris Waller was saying a couple of weeks ago, he has to look out to 3 digits to see what the real changes are in the CPI, and so we'll look for those as well.
Mike, stay close. Let's get to it. It is the most important number in international finance. And right now, this is the right kind of downside surprise. Equity futures positive by 0.8%. On the Nasdaq 100, up by 1 full percentage point. Check out the Russell, and then I'll give you the why. The small caps up by 2.3%. Here's the why. Switch up the board and turn the page and get to the bond market. The 2-year yield absolutely ripping. Yields down by 14 basis points at the front end of the curve, 4.69. We haven't seen 5% at the front end of the curve since the Fed last met on the first day of May. We have backed away, and we're backing away again. We're down 13 on 10s to 4.27. On 30s, we're down 10 to 4.43 89. Switch at the board and get to foreign exchange. You can guess what the dollar's doing. The euro is stronger against the weaker dollar. We're back through 108, 108.22, and positive by 0.75%. Lisa, stocks are up, yields are lower, the dollar's weaker. That's the right kind of downside surprise.
So now on to Act 2. How does Jay Powell interpret this? This is basically going to be opening the door to a July rate cut once again, because guess what? We're even closer to our goal. Looking forward, I think the reaction is fascinating in terms of what the connection is between the rate market and the stock market. It doesn't totally make sense that you see an outperformance of, say, tech stocks in addition to the Russell 2000. And there are some people who argue that, that rate cuts won't benefit small caps as much as some other sectors. A lot of uncertainties as we carry through. You've always said first reaction isn't the way we're going to end the day, and that certainly could be the case today. However, the right cut of downside surprise definitely making its way to a pivot party once again.
We'll see if it sticks. This is the first part of a two-part story. The next part is at 2 p.m. Eastern time when we get the Fed decision and forecast. 30 minutes after that, get a news conference with Chairman Powell. If you are just joining us, 0% month-over-month headline CPI. 0.1% was the estimate. Previous month was 0.3. Core, stripping out food and energy. In our survey, we were looking for 0.3. We got 0.2. Michael McKee's been poring over the numbers over the last 4 minutes or so. Mike, what jumps out for you now?
Well, one of the things, of course, that the Fed has been looking at is supercore, which is services less energy. And supercore comes in much lower than it has been at this point. It is up just 0.4% for a month-over-month basis, and on a year-over-year basis, we're up 4.8%. That's down only fractionally. So there's still some inflation on the services side that the Fed is looking at, but some of the services things that we have been worried about, like airfares, have not gone up. As a matter of fact, airline fares down 3.6%. Your surveillance co-anchor Anne Marie probably got a discount on her trip to the G7, so that's good news.
So, Mike, can you give us a sense, as you're a Fed watcher and an econ watcher, how you think this is going to filter into what we hear later today?
Well, I think it's going to probably reinforce what most of the officials came into the meeting with, the idea that inflation is going to continue to fall. They may not have put the exact numbers on it, but I don't think this changes anything in terms of anybody's view of how many cuts they're going to put into their dot plot. It does make the idea of changing their forecast for the PCE, and remember CPI runs a number of basis points above PCE, but changing that forecast, revising it up, maybe that makes it a little bit more difficult. But it's an interesting question for Jim Bullard because he's been in that room. It's rare that we get data this important on the day of a Fed meeting, but I know they can change their views for the SEP and the dots up until about mid-morning.
Jim Bullard, the stage is yours. The floor is yours. What would you do after that print?
I think this was good news for the committee. They've been looking for a softer report. They got it here, but the typical reaction would be, okay, this is good, but this is 1 month's numbers. We would need more news going in this direction in order to forge ahead with our easing policy. So I think that will be the baseline reaction. But it does keep hope alive for those that have been looking for an earlier rate cut.
You think the door is open for July?
No, I don't. I think the best you could do with July is set up a possible move in September, and you'll have more data by the time you get there.
Francis Donald of Manulife alongside us as well. Francis, I want to get out to you and get your early reaction to that CPI print.
I literally breathed a sigh of relief for a lot of reasons. I suspect Chair Powell did too, for consumers who are not going to see as much month-over-month increase in prices. For all the economists out there with a September rate cut in their forecast, they're probably also relieved. But also, bigger picture, higher rates are working to bring down inflation. This was an increasing concern. Are rates restrictive enough? Do we keep them this high? Why is inflation not moving downward? That said, John, this is one print. We have 3 more before the September meeting. And as exciting as this is this morning for a few hours, I'm more interested on the CPI print that comes out September 11th, just 1 week before the Fed's September cut. That number may end up being much more important than this one. So we'll take it as a win. It's good news for consumers, for markets, for all, but it's one print. And we got a lot of information coming through today.
Francis, Jim Bullard was also talking about the Payne speech. in Jackson Hole that Jay Powell gave a couple years ago when he said that essentially this is inflation that's running too hot and we are going to get inflation back down and it is going to require pain in the economy. Francis, you are expecting to see that pain. We haven't seen it on a broad-based level. Do you have a sense of whether this disinflation is the immaculate type that we've been talking about, or whether this is just one dot in a series where things are kind of shifting? We're at a tipping point.
I would hope that would be the outcome for the American people. At the same time, our leading economic indicators on the jobs front continue to show weakness ahead. We're at a 4% unemployment rate. I'm watching today to see from the Federal Reserve, they already had 4% penciled in for the end of this year. Are we really going to go through the next 6 months without an additional tick up in the unemployment rate? And let's remember, the simple rule of thumb is that it takes about 2 years for those rate hikes to work their way through the system. And we're 2 years and some change after that first rate hike. We're not at the end of the impact of rate hikes. We're at the very beginning. So while magnitude of the downside for the U.S. economy is up for debate, the direction shouldn't be. There probably will be a much larger slowdown in jobs in the second half of the year. And this is when the Federal Reserve will have sufficient data to begin cutting interest rates and bringing those rates down, beginning, we think, in September.
Jim, what's your take on that, given the fact that it seems like something that feels like a stretch for the unemployment rate to stay where it is for the foreseeable future?
I think it is immaculate disinflation. And again, I think that, by being credible and moving quickly, the Fed was able to get firms to change their pricing strategies quickly. The inflation came down relatively quickly. And so, one simple theory about how this works would be that the Fed threatens recession. Everyone looks ahead. They see that might be a possibility. They don't want to raise prices into that. And the inflation goes away relatively quickly. So that isn't the most popular theory around here or on Wall Street, but that is, that is something that you have to take into account, because the anticipated effects can overwhelm sort of the mechanical effects, and you get lower inflation right away. So this is something I was advocating for in 2022, that we, let's move quickly, let's try to quash the inflation quickly. And this report today is helping that story.
Forgive me for going off piece, but just entertain me for a moment. French 10-year. Yields down by about 7 or 8 basis points right now. That CPI print was more important to the European bond market than anything Macron's had to say in the last 12 hours.
The banker to the world, the reason why Jay Powell should go on tour, but ultimately it does highlight how this is the market that everyone is watching, regardless of some of the external factors.
Ira Jersey of Bloomberg Intelligence joins us now for a little bit on this bond market. Ira, the most important data point in global finance. Your thoughts on this one?
Yeah, obviously better than some people had feared. It was on the core CPI, it was a low 0.2, so it was actually under 0.2%. And I think that's something that traders have been able to kind of grasp onto. And like you noted, this is pulling down, all global sovereign bonds at the moment, where bond yields at the moment. So you look at German yields are down by 6 basis points, like you said, France down by 7 basis points, but remember, the beta to that is only half of what's going on here in the U.S., where you have 5-year yields off 15 basis points at one point. And that just shows that, we're now going to be pricing in for 2 full cuts probably before the end of the year. And then as you get additional data, obviously the market's going to have to shift those expectations pretty dramatically.
So, Ira, I have a question for you. So if you just took rebased where inflation is now, and you said 0.2 every report through the end of the year, you would get year-over-year core PC inflation on a 12-month basis at 2.8 at the end of the year. So we started out at 2.8 in January on that metric. We'd end up at 2.8. So maybe that's not really enough. You need even better reports in order to be able to show progress through this year. What do you think of that?
I think part of it, James, is the fact that we're not increasing, right? So a couple of months ago, when we had a couple of inflation scares, the market really dragged onto that and said, okay, what happens if the Federal Reserve doesn't cut at all this year, or maybe even hikes? Because keep in mind, in January, the market was pricing for almost no chance of the Fed staying on hold this year, and now we're actually pricing, or were pricing, I don't know where we are at the second, but we were actually pricing pricing via options on short-term interest rate futures for about a 20% chance of potential hikes by the end of the year. I suspect that if you get another print similar to this, where you have another, call it 0.2 again on the core, that people will say like, hey, progress is being made. The Federal Reserve is still more likely to remain on hold and or cut than they are to be even thinking about hiking interest rates before June 2025 at this point. So I do think that there is a sea change and it matters. And to your point, like I still think that the market is going to say, okay, what's the trend versus where we were, as opposed to just looking at, okay, 0.2 forever is probably not going to be sustained.
Ira Jersey of Bloomberg Intelligence. Ira, thanks for that. Appreciate it. If you are just joining us about 14 minutes ago, we got this data, 0.0% month-over-month headline inflation against an estimate of 0.1, previous number 0.3. Stripping out food and energy, Bramo, 0.2% was the number, 0.3 was the estimate.
And Jim Bullard, former St. Louis Fed president, just moments ago saying that this is the immaculate disinflation that many people were looking for. Francis Donald's still with us, and Francis, I'd love your take on that. Do you see this as the immaculate disinflation? Can you bet on that and arrange a portfolio around it?
Well, for June, it feels like immaculate disinflation, or for May, we had this really large decline or no change in inflation month over month and a pretty good non-farm payrolls number. That's exactly what this immaculate disinflation would be defined as. So now it's about what do we see next? And on this front, I do see some downward momentum that is occurring in the economy. But let's remember, if you're sitting on a trading floor, you're managing portfolios, numbers like this aren't just about changing your base case. It's not that something like this would make you move from a December to November or even to a September rate cut. It can often be about reducing the balance of risks or the tails of the risks to your base case. So this number probably isn't going to change anyone's outlook as to what will happen next. That'll be based on their forecast. But it does reduce the chance that the Fed would, if you had it in your scenarios, have to hike again, or that they have to stay for a prolonged hold. So sometimes it's about reducing those fat tails on your outlook as opposed to the individual. That is tradable, but usually around the conviction of your trade or the balance of risks or how much leverage you're putting onto it as opposed to the trade itself.
What could Jay Powell say today, Francis, that would really move the needle in your book?
Well, he could speak to some of his longer-term concerns that aren't inflation or jobs. For example, well, he can't do it, but interest costs for the federal government are very high. They're about 19% of revenue is going towards interest costs. If he were to talk about, and he probably wouldn't, some of the risks of higher for longer, that would move the dial. But we have 3 more inflation reports, 3 more of just about everything until we get to September. The Fed is in a holding period. The market is in a holding period. And each individual data point, each individual Fed commentary will be far less important than the sum of all of their parts. So as much as this meeting will get a lot of attention, I'm sure we'll talk about it all day, I'm far more interested about the evolution over the next 3 months. That will be more important than any singular event.
Francis, one of the best. Thanks for being with us. Francis Donald there of Manulife. Jim, Team September, Citi, Goldman, Morgan Stanley, they'll be feeling pretty good today. Do you think there's a risk here based on what you've said? I think maybe you do. Did we get too carried away with this print this morning?
Oh, that always happens in markets. So, again, I think this is one number. It is, as Francis said, a sigh of relief to some degree because it's the previous reports that have not come in softer that have been causing the angst. And so this is back on track for disinflation, but it is only one number. You're going to need more of this going forward, as Governor Waller highlighted in his recent speech.
Okay, so that's the formal take. The informal take. Behind the scenes.
You mean like the pretend the camera's not on?
Yeah, pretend the camera's not on and get in the room. How many of the Fed officials are saying, mission accomplished?
No, they wouldn't say that.
Not out loud.
No, they wouldn't say that even to themselves. They would say, no, we need, it's good to have a good number, but we get lots of numbers all the time, as you guys do too. And, you can't put too much weight on any one read, but it's encouraging. It's going in the right direction. I'm sure Jay will say that at the press conference.
Jim, you're going to stick with us. A final word from Jim in just a moment. If you are just joining us again, inflation, the right kind of downside surprise, coming in at 0% against an estimate of 0.1. Stripping out food and energy, we get 0.2. We were looking for 0.3. I'll get you more details on that in just a moment. I just wanted to run through the price action just briefly. Going into the opening bell, equity futures positive by 0.7% and a big rally in the bond market. Two-year yields down by about 13 basis points, briefly breaking 470 on a two-year. We're there, just there, right now. On a 10-year, we're down 11 basis points to about 429. Let's get you an update on stories elsewhere, as well as some details on the CPI report. Here's Danny Berger for more. Hey, Danny.
Hey, John. So that's the price action in the bond market. I want to go through what swaps are pricing at the moment. A full quarter-point cut is what we now have in November, about 20 basis points for September, and now a full 2 cuts for the entirety of the year. As you say, it came in flat for the month of May. And now we gear up for the Fed rate decision. That is at 2 p.m. Eastern. Chair Jay Powell's news conference, that will be 30 minutes later. Now, elsewhere, U.S. mortgage applications rose for the first time in 5 weeks. Mortgage rates did ease closer to 7%. That's according to the data from Mortgage Bankers Association. Applications to buy a home increased by 8.6%. The data is, though, prone to swings around the holidays, and the latest reporting week followed Memorial Day. The Biden administration is considering further restrictions on China's access to chip technology. Sources say that the measures being discussed would limit China's ability to use cutting-edge chip hardware known as Gate-All-Around, or GAA. It's unclear whether officials will make a final decision, the people said, emphasizing that they're still determining the scope of a potential rule. Companies like NVIDIA, Intel, and AMD are looking to start mass-producing semiconductors with this GAA design within the next year. And that's your brief, John.
Danny, thank you. Thanks for this morning. Coming up on the program, up next, we'll set you up for the day ahead, including a post-CPI Fed decision. Equity futures rallying hard as inflation starts to cool.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg.
Quite a market reaction. Equity futures positive by 0.8%. Big rally in the bond market. Yields much, much lower right the way through the curve. The 2-year out to 30s on a 10-year maturity down 11 basis points. A break of 430, 429, 46. We're counting you down to the opening bell. That's about 38 minutes away. Here's your trading diary through today and the rest of the week. Today at 2 p.m., Fed rate decision and forecast are released. Then 30 minutes later, a Chairman Powell news conference. Tomorrow, get some more data for you, plus another round of jobless claims too, alongside PPI. Friday, UMich consumer sentiment data, plus a BOJ. Now, Dean of the Business School at Purdue, boiler up, paid to say that, Jim, by my own manager, actually, not by you.
You literally are.
Who is from Indiana. Great to have you with us, Jim, over the last 50 minutes or so. Just a final word from you, what you're reflecting on based on what we've seen already this morning, going into this Fed decision later on this afternoon.
Yeah, this is good news for the Fed. The policy is working. We're bringing inflation down, so I think all of that's good. It is just one number. We'll need a string of numbers going forward that'll confirm this, and so hopefully we'll get that. I would just say something we haven't talked about is bond market volatility, and you had got a big reaction out of this number today. I've described the last 15 months in the 2-year as Mr. Toad's wild ride. It's really been very volatile, and sentiment shifting back and forth about how soon the Fed will. So I think it would behoove the U.S. economy to get that to settle down, maybe not be quite so dependent on individual readings on numbers. But if we can get going on the rate declines in an organized way, I think that'll probably settle down.
That volatility, is it a sign of the financial market strength that it hasn't taken it down, or just a point of fragility?
I just think inflation declined so rapidly in the second half of 2023, and in the way Fed policy works and markets work, that got extrapolated out, that would continue, and we'd be at 2% by now, like right now, and then you'd have to lower rates a lot, and then you got these data that come in the other way.
Isn't the Fed responsible for this volatility, though? Isn't this the Fed?
No, I think it's a combination of the Fed interacting with the data as the data has come in. It was a surprise that inflation went down so much, but then leveled out. I mean, maybe ahead of time you could have predicted that, but I didn't think.
What's your best guess now? Let's finish on that. What is your best guess for this year and beyond, based on this morning?
2 rate cuts this year, based on where sitting here today, looking at this data, I think that's the most likely outcome.
Any idea on the destination, the ultimate settling point?
I think, I don't have a good model of it, but I think 3.5 on the funds rate, and then 10-year trading at 4.5. Then you'd have a nice upward sloping yield curve. The soft landing would be complete.
That's like the dream. Jim Bullard.
That's the dream.
Jim, thank you, sir. The former St. Louis Fed president and now Dean of the Business School over at Purdue University. Coming up, fantastic lineup. TK is going to be just in that corner, away from me, alongside Bramo and me. We're going to be catching up at 1:30 Eastern Time. Here's your lineup. Special edition of Bloomberg Surveillance with Tom singing The Fed Decides. Like he'll be singing now as we come into the show, no doubt about it. We'll be joined by JP Morgan's Bob Michael, Julia Coronado of Macro Policy Perspectives. We'll catch up with KPMG's Diane Swonk and Mohammed Al-Arian. Fantastic lineup a little bit later.
At a time of incredible volatility in the right direction, I guess, for the market today, we can take a look at how much the bond market has reacted. Will it stick after the press conference?
Well, right now, this is what the move looks like. Equity futures positive by 0.8% on the S&P, and quite a sizable bond market rally from New York City. This was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
From New York City, for our viewers worldwide, we are off to the races after inflation came in lighter than expected. We should hit all new highs today on the S&P and the NASDAQ. The countdown to the open starts right now. Good morning, I'm Matt Miller. Coming up, another downside surprise for U.S. inflation, sending futures higher and yields plummeting as investors count down to Chairman Powell. We begin with the big issue, signs of slower inflation.
This was good news for the committee. They've been looking for a softer report. They got it here, but the typical reaction would be, okay, this is good, but this is 1 month's numbers. We would need more news going in this direction in order to forge ahead with our easing policy. It does keep hope alive for those that have been looking for an earlier rate cut.
Joining us now to discuss is Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. And Lori, I was pumped for the CPI number today. I think it's less exciting, a little bit less exciting, but good, obviously, for America if it comes down. Does this mean that the Fed can start to give us a clearer picture of the rate path forward?
Well, thanks for having me on, as always, Matt. Look, I think we're going to have to see what they say. I do think this was a good print this morning, but one of the things that my rate strategist really emphasized to me coming in today was that one good print was not necessarily going to be enough to change our house call, which is for a cut in December. And they thought that the Fed was really going to need to see a number of good prints, just the way we saw a number of bad prints to start the year, that we were going to need to see a number of good prints before we really want to start getting excited again.
So your house call is for only one cut and not until the very end of the year, right? Do you expect the dot plot to show also only one cut today from the Fed?
You know, I'm not in the business of forecasting the dot plot. I'm going to leave that to the experts there. But what I will be looking for generally as an equity person is the direction of travel of forecasts on the sell side generally. And if I look back to that last Fed meeting, I think one thing that really concerned me was that after we got out of the press conference, we really saw people latch onto a very dovish narrative and take it too far in one direction. And then we had to dial that back down, and that generated some volatility in equity markets. So, you know, I look at this as an equity person this morning as a good print. I'm excited to see it, but I'm also a little bit worried. I think Bullard called it Mr. Toad's wild ride in the last show. I'm a little bit worried about getting back in line for that again, to be honest.
All right, Lori, we do see futures jumping higher. We see yields coming down, and I'm excited to talk to you about your view on equities with these new market moves. Right now, though, I want to get more on the CPI print. For that, we go to Mike McKee. He's our Chief Economics and Policy Correspondent standing by in Washington, D.C. Mike?
Matt, I'm trying to do something with Mr. Toad's wild ride, but I can't really think of a way to weave it into this other than the fact that maybe Mr. Toad's jumped into the water and is going down, because that's what happened to inflation. Almost every category comes in lower than anticipated. The headline number comes in flat. The core comes in up just 0.2% on the month, which pushes the year-over-year numbers down, particularly for core, by 0.2 to 3.4%. Supercore is the only thing that went up, but that was base effects. On a month-over-month basis, Supercore was down. So there's still good news to come there. In terms of what moved, well, it's been a lot of things that we have been expecting to happen, but have not happened up until this point. Gasoline, we knew would be down. 3.6% was a fairly high number. But look at motor vehicle insurance. It had been up 22% over the past year. It comes in down this past month. First time since 2021. New vehicle prices down 0.5%. Owner's equivalent rent is up 0.4, but it's a low 0.4 when you round it out to 3 digits, and that suggests, according to some analysts already who are publishing, that we will see, because of base effects, rent finally starting to go down, housing finally starting to go down in the next few months. Now, something Lori said about seeing more of this before the Fed makes any decisions. That's exactly what Chris Waller said, the Fed governor, last month. He said, in the absence of a significant weakening in the labor market, I need to see several more months of good inflation data before I would be comfortable supporting an easing in the stance of monetary policy. I think we can count this one as 1 month. So 2 more months, June, July, that would put perhaps September into play. And so we move on to the next item on our list, which is the dot plot. What's it going to say? 2 or 1 or what? And then it's our birding hour. Does Jay Powell change the direction of the markets, create that volatility Lori was talking about? Will he be dovish or hawkish, contradict anything? It's going to be a very interesting news conference to listen to.
Mike, it's interesting that you say September is in play. I've got a viewer writing in with a question for you. He says, ask Mike, how much does the election around the corner play into the rate cut situation?
It's not going to play into it. The Fed is going to do what it wants to do, what it feels it needs to do, when it needs to do it. There'll be a lot of people who think that the Fed is going to be influenced by the election, but history shows that they aren't. And also, September 18th is not that close to the election comparatively. So if they wanted to do one, wait a meeting, and then do another, September, wait November, go December would be good timing for them. But this is all going to depend on what the inflation data do between now and then.
All right, Mike, thanks very much. Michael McKee is our Chief Economics and Policy Correspondent coming to us on CPI from Washington, D.C. Now, the number comes in lighter than expected, and Matt Maley over at Miller Tabak says after the print, between Apple's upside breakout yesterday and this morning's CPI number, the only thing standing in the way of a further strong rally is Chairman Powell. That's what Mike was saying in terms of the bird watching today. Let's get back to Lori Calvasina. She is the head of U.S. equity strategy for RBC Capital Markets. Lori, do you agree that we have much more room to run in this rally due to the lighter print, Apple's AI strategy, and hopefully, I guess, a more dovish Jay Powell?
So it's a great question, Matt. You know, unfortunately, I'm going to tell you that I still feel pretty neutral on the equity market in here. Of course, there's always the possibility for further upside. The tools that we use as a strategist, they tend to be compasses, not GPS. And I certainly don't feel like I'm part of the bearish camp. But when I go through my modeling in terms of looking at inflation rates, in terms of looking at what the Fed might do, in terms of looking at where 10-year yields might end up at the end of the year and what that all implies for PEs in the market and ultimate levels, the best number I continue to come up with is about 5,300, and we're obviously a bit above that right now. But I'll tell you that that scenario in my valuation model comes in with the idea of 1 or 2 Fed cuts, 10-year yields that move down to 4.19, and get a PCE that gets back to 2.6%. That's been the sort of published consensus on the sell-side economics community. That's what we layer into our model, and that's already telling us that about where we are today, even a little bit below, is about fair value. So never say never, but in here, I do think a lot of this has already been priced into equities.
Lori, I'm going to show you a Bloomberg function here. It's the RRG, relative rotation graph on the S&P, and you already know what it says because you've been talking about this in your notes. We see leadership from IT and communication services. So really the Mag 7 leads no matter what range you put. I tried it with 1 month, 3 months, 6 months, 12 months. It's always the Magnificent 7 in the leadership position. Will we see a shift back to maybe value? Will we see a shift back to any of the other S&P industry groups as, you know, the 10-year yield starts to come back down? We've seen it come off its April highs and it continues to fall today.
It's a great question, Matt. And, you know, one little quirky chart that we've come up with looks at the post-SVB environment. And if you look at 10-year Treasury yields and just whether or not they're going up or down, and you compare it to, say, the performance of the top 5 names in the equity market against the rest of the S&P, just equal weighted baskets, what we've generally found, and this is a very short time horizon, but we've generally found that when yields are rising and there's more nervousness in the market, that's when we tend to see those top names really cling to their outperformance. And when we get those downdrafts in the 10-year Treasury yield, that's when the rotation trade tends to make itself known and tends to try to flare up again. So if we did get a break in yield, I think that argues well for a value rotation. But I think the other thing that we really need to see for rotation out of those safer type names is a reinvigoration of economic expectations. And if you look at real GDP forecasts for this year, they've kind of stagnated around 2.4%, which is just below average. To really get rotation in the market, you need to see that number pop up above average, kind of get a little bit closer to 3%, well over 2.5. We just haven't made any movement there recently. So I think you've really got to have both of those things happen for that rotation trade to get going again.
We did see mortgage applications jump this morning at 7 a.m., up 15%, and it's a big move above what we've seen all through the last year as rates come down a little bit. I also note that Amanda Agati from PNC, she's the chief investment strategist there, was saying, look, for the 493, right, for the other stocks in the S&P 500, we've been in a 6-month earnings recession. You talk about the economy moving. Are we going to see the 493 start to boost earnings? Is that housing picture going to start to boost things as mortgage rates come down?
All great points, Matt. And I'll tell you, for most of this last reporting season, when we looked at the rate of upward revisions in the market, we looked at this time the top 10 stocks versus the rest of the S&P 500. For most of this 1Q reporting season, we were getting more upward revisions to analyst forecasts on those other 490 stocks. You were getting fewer on the top 10. Then we slammed into retail reporting season. In these last few weeks, we've actually seen the reverse happen. And so the top 10 names have been where all the earnings excitement has been, again, on a relative basis. So we can see the early signs of healing on the earnings front starting to happen in the broader market, but it did hit a pretty big pothole with those retail reporters. The other thing we talk about a lot, Matt, is that if you just look at forward growth estimates, and Bloomberg has fantastic data that comes up every Friday on this, but really you can see that there's a deceleration in the Mag 7 earnings growth embedded in current consensus forecasts and a re-acceleration in the rest of the market. And guess what? In 2025, those two lines are getting pretty close to converging. So I do think it's not just a question of, kind of a recovery in the broader market. It's a recovery that can rival the growth rates of those Mag 7 names. So far, that's proved elusive, but it might be getting closer within the next year or two.
Lori, you talk about retail, which is something we've been watching very closely. We're concerned about the consumer maybe loaded up with debt and discriminating more when it comes to purchases. I have famed bearish economist David Rosenberg coming on in a few minutes, and he says we've seen a visible diminishment in corporate pricing power. Do you see that as well?
So it's a great point, Matt. You know, I have noticed when we read through earnings call transcripts, if I go back to the calendar first quarter when we were getting the 4Q prints, the company commentary about inflation was just really, really hot. And it's not so much that the pricing commentary was really hot, but we did see corporates really being pressured by those inflationary prints. And we saw, you know, a decent amount of evidence of some companies trying to cling to that pricing power. As I got to this last reporting season, I will say that the complaints about input cost pressures really seemed like they died down a bit. They weren't completely gone, but they weren't just as hot as they had been in the prior one. And we have noticed, you know, just in recent quarters, if we go back, you know, what we've seen the last few quarters versus what we've seen the last few years, the pricing commentary just isn't as strong as it's been in the past. So I think that's probably a pretty fair comment just based on what I've seen bottom up.
Lori, great to get your take this morning. So happy we could have you on. Lori Calvasina there is the head of U.S. equity strategy at RBC Capital Markets. Joining us now with a look at some of the individual stocks moving ahead of the opening bell today, and we do have a rising tide, so I'm going to guess that most boats are floating. Here's Abigail Doolittle. Abby?
You're absolutely right about that, Matt, with the futures up about 0.9% for the S&P 500, up for a third day in a row, the best 3 days since the middle of May. Yes, we do have stocks higher, one of them being Oracle. Now, they, of course, did report earnings. A little bit mixed there, but the stock is surging because they also did sign cloud infrastructure deals with both Google Cloud and Microsoft and OpenAI. So they're saying that that cloud infrastructure service revenue that yesterday came in at 42% growth, below 50% over the last 2 quarters. Well, it's going to go back above 50%. So investors are really liking that. Now, relative to banks, we have a nice rally there with CPI coming off. JP Morgan, along with Citigroup, are higher. Key, the regional banks really getting a big move up. And that Russell 2000 on the bottom of the board here, Matt, we have IWM, something we typically wouldn't take a look at, but given the rally off of the basically inline CPI print, we have small caps off to the races right now, heading to the best day of the year.
All right, Abigail, thanks very much. Abigail Doolittle looking at stocks on a day when we are ready for a rally. Coming up, CPI data fueling Fed cut wagers.
I literally breathed a sigh of relief for a lot of reasons. I suspect Chair Powell did too, for consumers who are not going to see as much month-over-month increase in prices.
We'll discuss with one of the market's most famous bears, David Rosenberg of Rosenberg Research, joins us next. And he sees there's real difficulty for corporate pricing power. We'll talk about that with him next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
literally breathed a sigh of relief for a lot of reasons. I suspect Chair Powell did too, for consumers who are not going to see as much month-over-month increase in prices. For all the economists out there with a September rate cut in their forecast, they're probably also relieved. But also, bigger picture, higher rates are working to bring down inflation. This was an increasing concern. Are rates restrictive enough? Do we keep them this high? Why is inflation not moving downward?
All right, for more reaction to this morning's CPI data and much more in the market, we are joined by David Rosenberg, Rosenberg Research founder and president. I still remember, David, when Business Week named you one of the 4 horsemen of the great financial crisis, which I guess was a good thing. You called it. What do you think about the current inflation picture? Because we're all very excited for the CPI number. I know it's only one print today, but it came in a little bit light. And does it show that maybe the Fed's on the right path?
Well, I think that that's the case. And I think that what today's report did was underscore how a few of these components in the CPI and primarily auto insurance, which actually went down 0.1% in May. The deviation between what happened in the opening months of this year compared to the disinflation momentum last year came down to a couple of areas. Auto insurance was the poster child. There was also financial services. Well, that deflated in the report today as well, and healthcare insurance, and that moderated. So it was narrowly confined. I thought the numbers today, and I wrote about it, were going to come in for a change below consensus. I'm pleased that they did. But, we got to remember that the CPI is truly a flawed statistic, where a third of the index is the rental metrics. And all we have to do is just look at the Fed Beige Book, which actually reflects what business contacts are saying, industry by industry, across the entire country. And the Beige Book that came out for May showed what I'd written about and that you mentioned, which was this diminishment of pricing power. And what's happening is that consumers finally, now that the savings cushion is gone, consumers are now realizing just how punishingly high the price level is. And so now you're seeing businesses being forced to respond, and that's going to come out of margins.
So we do see the savings rate completely gone, and consumers have become more discriminating. On the other hand, we saw mortgage applications this morning, David, shoot up like 15% and change. And, they had been dropping, I think, 5.5% last month. Obviously, with rates this high, it's more expensive to get a mortgage. Builders aren't excited to start new projects. But is that slowly changing as we see, rates come off their April highs?
Well, that's a bit of what I would say is a contra-cyclical indicator. You'd have to ask yourself the question, if households are so flush with wage income and cash flow, why would they now be resorting to cash out refinancings? So it's actually a measure at the margin of accelerating consumer financial stress beneath the surface.
So that isn't a great look then for the consumer. Savings rate also bad. What about the labor picture? That's the key, right? And I was talking to my buddy Joe Brusuelas this morning, and he said, ask David about this flawed statistic, because we saw in the last report a non-farm payroll jump of like 275, but the household survey showed a drop of 400. So what does the labor picture look like?
Well, decidedly mixed. The odd man out on the labor market side was non-farm payrolls, but you see, the Fed has trained everybody to believe that it's the holy grail of the labor market statistics, and historically, the non-farm was the gold standard. But here's the problem: is that since COVID, the response rate to the initial report is barely more than 40%. Before COVID, it was over 60%. And that's why you're seeing this really historical development taking place in the data, which is what non-farm payrolls look like 3 months later. And it's remarkable that the revisions have been squarely to the downside and are more than double, almost triple what they've been historically in terms of the last estimate you get on payrolls and the first estimate. So of course, everybody trades off the first estimate, then they forget a few months later that actually the number was a lot lower than what was expected. And so that's very interesting because the response rate being so low has made the non-farm payroll survey, let's just say, less veracity in the initial report than it had in the past. And let's also keep in mind that in the past year, half of the growth in the establishment survey wasn't even from the survey, it was from the birth-death model. So I would say that, you know, the household survey right now, when you trend it out, household survey employment growth year over year is running at the grand total of 0.2%. And all of that 0.2% is in part-time jobs. Full-time jobs are down almost 1% year over year, which in the past 7 decades has only happened when the economy was in recession.
No.
And the non-farm payrolls are showing 1.8% growth. It is a very wide divide, and it's just showing a lot more confusion into the picture. But my money is on the household survey, not the payroll survey.
All right, David, I'm going to get your take on the dots, what the Fed does going forward. I also want to get your take on the Mag 7, the earnings recession that the other 493 are in, and the markets. We're going to get David Rosenberg back in just a few minutes from Rosenberg Research. Coming up, the morning calls, and Constance Hunter is going to join us as well of Macro Policy Perspectives. She says not all paths to a rate cut are priced in these markets. She's going to join us later this hour. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Time now for the morning calls. First up, Goldman Sachs downgrading Birkenstocks to a neutral. The firm notes the strong brand momentum, but recent strong performance leaves the shares fairly valued, they say at Goldman. Next up, Wells Fargo is cutting Paramount to an underweight, saying Sherry Redstone's decision to walk away from merger talks with Skydance will add to the long shadow over the company. And finally, Mizuho downgrading NextEra Energy, Bill Gross's pick, to a neutral. They see limited incremental catalysts for the stock to go higher.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is the countdown to the open. I'm Matt Miller. Moments away from the start of trading, we are looking at futures higher across the board, and this will drive us once again to an all-time record high on the S&P. I believe it'll be the 27th record high when the cash trade kicks off. There you hear the opening bell, and we see some real glam here on the New York Stock Exchange floor as Estee Lauder rings the bell. Very interesting group there up on the balcony. Let's take a look at some of the other assets that are moving today. The euro had been down with a 107 handle the last couple days. It's popped back up now to 108 and change, where it has been for the last month. Otherwise, the U.S. 10-year coming down, now 428. And as we see yields moving off of their April highs, we got a big pop in mortgage applications today. I thought that was very interesting. NYMEX crude approaching $80 a barrel again, right now up $1.33 to 79.23. One of the stocks that we're watching closely at the open today is Oracle. That company reporting better than expected bookings and announcing partnerships with rivals Microsoft and OpenAI. Abigail Doolittle has more on, I guess, the AI partnerships that we've seen the last couple days, Abby.
Yeah, that's really the big piece of this story, because they actually missed earnings. And in the after hours yesterday, we had this stock briefly all over the map. So those partnerships with Google AI and Microsoft and OpenAI came out before the earnings. The stock popped after having been down on the day. Then the earnings miss came out. It was down a little bit. And then investors really are focusing on that cloud potential, because, in fact, the company is saying that their cloud infrastructure, that key business part, that the growth will return to above 50% on an annual or on a quarterly basis on a year-over-year look. And that's where it had been in this most recent quarter. Importantly, it was a little bit better than expected, 42% growth, but down from before. Now, analysts on this name are encouraged, but still staying somewhat neutral. Mark Murphy over at JP Morgan, somewhat of an axe on any company he follows, staying neutral. Interestingly, on the Cerner, that is expected, that healthcare acquisition that they made back in 2022, expected to drag on the year by 2%. But the update that we got, that they will no longer be breaking that out, considering that it's now a part of the operating structure and returning to growth. So overall, investors really liking these results. The stock up 9.3%, heading, Matt, to its best day since the middle of March.
Got it. Abby, thanks very much. Abigail Doolittle looking there at Oracle. Let's turn now to the autos industry. Stellantis rising after the EU announcing it'll impose additional tariffs of as much as 38% on EVs shipped in from China. A little protectionism never hurt a stock. Bloomberg Global Autos editor Craig Trudell is here with more. Craig?
Yeah, it's maybe hurting some Chinese stocks, but absolutely is a positive for Stellantis, in part because this is a company that really, its bread is buttered by the mass market segments in Europe. They really, that is also where the concern lies in terms of, Chinese EVs coming into Europe and potentially having the ability to undercut manufacturers like a Stellantis, like Volkswagen on price. And you do have some concerns if you're a Volkswagen or some of the German manufacturers of retaliation, of course, and we have a situation in Stellantis where this is a company that doesn't have a significant presence in China and is able to sort of avoid some of the crossfire that maybe some of its compatriots in Germany are now worried about as a result of the move today by the European Commission.
Yeah, I remember when they pulled out some of their last remaining Jeep factories out of China, but it's a very good point, Craig. We should remember that there are a lot of Western automakers that count on China for a huge piece of their revenue, so it does cut both ways. Craig Trudell there, our auto czar out of London. Let's turn now to the meme stocks picture this morning. GameStop raising about $2.14 billion from a share sale program, capitalizing on a rally fueled by Keith Gill, also known as Roaring Kitty. Typically, when a company sells shares, that is a problem for the current shareholders as it dilutes their holdings, but with this stock, it hasn't hurt in the past. Today, it's down 5%. Alex Semenova joins us with more. Alex?
Good morning, Matt. Well, GameStop has been struggling with a failed e-commerce strategy. It's been seeing its stores closed, but one thing that it has going for it is its cash holdings. That's thanks, of course, to Keith Gill, aka Roaring Kitty, returning to YouTube and rallying up retail investors. GME raised $2 billion on the sale of 75 million shares. In total, it has raised $3 billion in the past month on these share sales, as of course the retail frenzy comes back. The stock is down right now about 6%. As you mentioned, it's been seeing some wild swings back and forth. I want to note as well that this morning, Andrew Left of Citron Research said that he is no longer short the company. He, of course, has been badly burned on his short position in GameStop, both in 2021 and again on this meme stock mania return. He said, though, that leaving his short is not because he believes in a turnaround for the company, but because he respects the market's irrationality.
He respects the irrationality. I like that. Alex, thanks very much. Alex Semenova there on GameStop. We are back now with David Rosenberg, founder and president of Rosenberg Research. And David, a lot of people diss the dot plot. I get it. It's simple, maybe too much so, but I still like to look at it. And of course, we're waiting to see where the dots are today. I note that I recently learned Powell tells the other Fed members that they can change their dots as late as, this morning past the CPI numbers. What are you expecting on the dot plot for this year?
Well, I think that they'll probably go to 2 cuts. I know there's some people that think that the median will show 1 or maybe even none. Look, the Fed historically is a very deliberate, slow-moving institution. So I don't think they're going from 3 at the margin to 1. I think they'll show 2 cuts between now and the end of the year today.
So, and that'll, set off the equity markets again. We've been on this incredible rally, all fueled by those big 7 mega cap tech stocks. Does that continue in your mind? Do we continue to see this rally as Andrew Left maybe fittingly says he respects the irrationality of the market?
Well, look, this is, nobody wants to call it that because it's so insulting, but it is a bubble. And I guess if you believe that this bubble will get as big as what we saw, in 99 and early 2000, then sure, the sky's the limit. But, we backed out what the 5-year EPS growth estimate is embedded in the S&P 500, and it's 17% per annum. That is the 5-year embedded EPS growth expectation, and it took on a huge inflection point when, in May of 2023, after that initial blowout NVIDIA report. And so it's all about generative AI and how that's revolutionary. I think it's maybe more evolutionary, but the market is speaking. Historically, the 5-year EPS growth in the S&P averages out to be around 6%. We're at 17% right now. So, you know, there's a lot priced in. And of course, as you said, you're seeing it in the relative performance of the Mag 7. You know, their earnings are up 100% over the past year. The rest of the market, the 493 stocks, their collective earnings are negative 3%. So, you know, as you said before, there's bifurcation in the employment data, and there's huge bifurcation in the stock market. But, you know, who can call what the top is going to be on these mega cap tech stocks? It's probably going to take ultimately some disappointing guidance, which ultimately is what brought Cisco down to its knees heading into 2001, if you remember. But that's really what it's going to take.
I do remember, and there have been some comparisons between now and then. But, David, without exception, every single strategist I've spoken with over the last month has said that she or he sees a broadening out in this market. And to be fair, I haven't spoken to a lot of bears because there really aren't any left, right? Do you see that breadth coming back to this market? Where do you look to measure that? Is there a rotation coming back? What are the data points that you're focused on?
Well, the problem that I have with the broadening out view is what's the catalyst going to be? Because so much of the other part of the market that's lagged behind is value or cyclical, and the economy is slowing down. People are still looking at the economy in the rearview mirror. They still think it's strong. I hear all sorts of former Fed officials on your show and other shows talking about the strong economy. No, that is in the rearview mirror. That was last year's story. We've taken a 3% growth economy, and now we're basically call it somewhere between 1% and 2%. And what's happening is that you're having aggregate demand growth in the United States falling below the trend in aggregate supply. What does that do? Well, it does what we talked about earlier, Matt. It ultimately triggers a diminishment in pricing power and top line growth. So I don't see what the catalyst is going to be for the other parts of the market.
What, you know, David, Atlanta Fed now has 3.6% for GDP growth next quarter. Yesterday, we got headlines from the World Bank raising their estimate of not only U.S. growth, but also global growth. Do you not see that view picking up?
No, I would say that I'm on the other side of that trade. And, you know, you could mention the Atlanta Fed, but the St. Louis Fed nowcast last I saw was 1.2. So yet more confusion, more bifurcation. Atlanta Fed over here, St. Louis Fed over there. Remember the St. Louis, the Atlanta Fed was close to 4% just a couple of months before we got the release of first quarter GDP, which came in at 1.3. So no, I am seeing decisive signs that the economy is cooling off, and it doesn't have to be a recession call. What's happening here is that the growth in aggregate demand is slowing below the pace of aggregate supply. That is why these inflation numbers are going to continue to melt.
Got it.
And that was exactly the tone in the Beige Book, which is the real world. It's not a world of massaged consumer price data from the Bureau of Labor Statistics. That is what business contacts are telling you. So tell me, why is that going to change? I mean, we saw that in practically every Beige Book so far this year, with an exclamation mark for the May Beige Book, telling you that corporate pricing power is receding. What's going to cause that to change over the course, say, of the next several months? And that comes out of top-line growth.
I'll tell you what.
So no, I'm not exactly optimistic about the value proposition of the cyclical stocks, which I would admit that we will need that as an offset, you know, once these high flyers, you know, start to catch down to reality. But I see that as a low odds bet.
I get that, and I'm going to put that question to my next guest, David, so I really appreciate your time. David Rosenberg, founder and president of Rosenberg Research, and maybe one of the very lonely bears out there on the economy. We did get a revision in GDP for the first quarter, down from 1.6 to 1.3. But on the other hand, we've been getting revisions up from, like, the World Bank. Coming up, we're going to count down to Chair Powell, obviously, the big Fed decision coming out at 2 o'clock.
One good print was not necessarily going to be enough to change our house call, which is for a cut in December. And they thought that the Fed was really going to need to see a number of good prints.
We look ahead to today's Fed decision next with Constance Hunter of Macro Policy Perspectives. I'll ask her what she thinks about aggregate demand coming down below aggregate supply. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
One good print was not necessarily going to be enough to change our house call, which is for a cut in December. And they thought that the Fed was really going to need to see a number of good prints. As an equity person this morning, as a good print, I'm excited to see it. But I'm also a little bit worried. I think
Lori Calvasina there talking about the concerns. Apple investors not seeing any. Those shares rising 2.5%, now set to overtake Microsoft in terms of total market value. Obviously, it's in that $3 trillion club, $3.26 trillion right now. Only others are Microsoft and, of course, NVIDIA. Let's talk with Constance Hunter right now. She's Senior Advisor at Macro Policy Perspectives. I'm very excited to be able to get her on the show because she was just over there in radio with Paul Sweeney. You're working with Julia Coronado, which is really exciting. You know,
It is exciting.
I haven't seen you in a long time because I've been on paternity leave for the last 6 months. But what a day to have you on after we get this print showing that inflation is softening a little bit. And I just talked to David Rosenberg. He said, you know, that's because aggregate demand is falling below aggregate supply. Do you buy that?
David Rosenberg is a perennial bear, and
yes,
it's good to have those people in the market.
There aren't many left. Who else is there?
It's hard to find them, I agree. Look, we are seeing softening demand, and you see it when you look at the prices for consumer discretionary goods. Those are all coming down, and you saw it in the beige book, consumers sort of pushing back on price increases. You see it with this price competition from Target and Walmart and Amazon, and that's good, right? That's a really good thing. What we now need to happen, and which will probably happen, is we need to cut rates enough that we get a positive sloping yield curve. Because if that happens, yes, we might experience a soft patch before that happens, but there is so much fundamental goodness in the U.S. economy, right? If you look at household
Is it still there, Constance? We saw the revision down in Q1 GDP from 1.6 to 1.3, and David was talking about one of the nowcasts also being down there in the doldrums, 1 point something. On the other hand, the World Bank yesterday raised its estimate for U.S. growth from 1.6 to 2.5%.
So, I mean, look, Canada, maybe sitting in Canada, it's harder to be as optimistic. But look, we have much better productivity. Canada doesn't have that productivity story. We have really strong productivity. And if you look at gross domestic income, we're running at about 2.5, 2.8%, right? That is perfectly reasonable. If you think potential GDP is 1.8, running at 2.2, 2.4 is running above potential. First quarter was an anomaly because of inventories, right? And let's not forget trade, which has been a drag and will still be a drag, is unlikely to be as much of a drag because you're now having a positive tailwind from the global economy, right? That we haven't seen for 4 years.
Okay, but therein lies the conundrum for Jay Powell, right? If economic growth is still strong, if the labor market is still tight, as the non-farm payrolls numbers seemed to bear out last month, how can he cut rates without goosing inflation back up to it's already at an unacceptable level, though coming down, it would turn around and go back up.
Okay, labor market is not collapsing, but let's not forget, we're seeing little ticks up in the unemployment rate, right? And yes, we saw a pretty strong headline print on the establishment survey, but if you look at the household survey, there's persistent weakness there. You look at some of the other labor market data, the labor market is coming into better balance. And historically, you're right, the Fed has not moved until they see weakness in the labor market. But we also are in such a unique cycle where inflation spiked, inflation's now on its way back down. And don't forget, the Fed can start cutting, and if they cut every other meeting, we are still gonna have restrictive policy. Even if you believe Fed funds is at 3.5%, right? We have many more cuts to get to 3.5%. And by the way, that is an elevated R-star level, right? So most of the participants are saying R-star is closer to 2.6. Right? So the Fed has plenty of policy space to begin cutting and still be restrictive and still take some bite out of demand while not hurting the parts of the economy that are going to be really helpful, like CapEx that helps improve productivity. That's the part they don't want to kill, right? And it's really important they don't kill that part because that's going to mean we're going to be able to run at a higher growth rate with lower inflation. They want to be able to have policy rates at a level where companies are still investing in productivity enhancing investments.
So, all right, for dummies like me who look at the dot plot, what do we expect? What should we expect today? Because most economists that I've been, IBing with are saying maybe they'll show 2, but I don't believe they can do more than 1. Or maybe they'll show 1, but I don't believe they'll be able to do it at all. What do you think?
So we're thinking 2, and we've been at 2 cuts for a while now. We think their first one is going to be in September, depending upon how the data play out, probably the second one in December. And we think that that's still very plausible, still very reasonable, especially with today's data.
All right, Constance, thank you so much for coming over here from radio. We need to get you back on as soon as possible. Constance Hunter there. She is Senior Advisor at Macro Policy Perspectives. Let's get some of the price action, some of the sector price action that we're looking at this morning. I'm guessing, they're all up. Let's go over to Abigail Doolittle right now.
They're almost all up, Matt, but we have so much going on here, it's hard to know where to start. So let's start with the S&P 500's greater than 1% gain, now being led by technology, up 2.4%. This has to do with Apple absolutely breaking out out of a range that looked like it was going to break to the downside. It could still be a false initial reaction, but right now the bulls are really trying to take Apple higher and succeeding. The second best sector, real estate, up 2.2% at its highs. It had been on pace for the best day of the year, having to do with yields plunging. Now, with yields plunging, it's interesting because utilities down about 0.8%. That sector should actually be doing better. Those dividends should be looking a little bit better, but it seems like the AI attention is going to tech on both Apple and Oracle. If we dig into the real estate sector, we are going to see big gains, Matt. And I talked to sources, developers, many times each week talking about the sensitivity to rates recently. One home building company telling me they track that 10-year yield basically every 5 minutes. Well, today they're probably pretty happy, up 4.9% for that sector, the best day of the year. And then take a look at office, that beaten down sector, up 6.2% on the hope that maybe rates are going to come in and make those cap rates look more attractive, values look a little bit more attractive, a little bit of hope, at least today.
More people going out there to try and catch a falling knife. By the way, Abigail, when I look at the breakdown of the industry groups on the S&P, and if we want to pull that up again, we'll see the losers that you just showed are healthcare, consumer staples, and utilities. Those are very defensive sectors. So is that bullish?
Yes, that's a great point. I'm glad that you're pointing that out. I said there's so much going on, it's hard to know where to look, but you're exactly right. The fact that those three sectors, utilities, staples, and healthcare are down, well, that's actually bullish.
Abigail, thanks very much. Abigail Doolittle there. Coming up, the market-moving events you need to be watching. That's next in our Trading Diary. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg.
Time now for the Trading Diary. What you need to be watching, obviously the Fed rate decision is it today, due out at 2 p.m. Broadcom reports results after the closing bell. Look at that. Tomorrow we get earnings from Adobe, and on Friday we get the BOJ decision, possibly more important for Americans, the University of Michigan consumer sentiment data. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.
just looking at your portfolio of businesses, it is about resilience. It's about pressure. It's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Brokers Studio in New York City to our worldwide audience. Alex Steele and Paul Sweeney, we are live here. We are streaming live on YouTube as well, so head over to youtube.com and search Bloomberg Podcast. It is CPI day, came in softer than expected. It's Fed day. We'll hear from the Fed at 2 p.m. Wall Street time of the conference with media at 2:30, and Bloomberg will be all over that. Coming up today, we're going to check in with Jeffrey Cleveland, chief economist at Payton & Regal, get his thoughts on this inflation print and on our Federal Reserve. Anurag Rana is going to join us too, Bloomberg Intelligence technology analyst, break down some of the Oracle numbers and just big tech overall. And then it is Fed Day, so that means we have to talk to Danielle DiMartino Booth, CEO and chief strategist for Q Research, our go-to voice on all things Federal Reserve. So we got a busy couple hours coming up, and we will get to it right now. Let's check in with Amy Marsh and get a Bloomberg Business Flash. Amy, what do you have for us?
Hey, Paul, a key measure of underlying U.S. inflation stepped down for a second month in May. It's a pleasant surprise for Federal Reserve officials looking for signs that they can start to lower interest rates. We've been talking about this all morning long. The core consumer price index year over year rose 3.4%, cooling to the slowest pace in more than 3 years. Stocks continue to gain while bonds continue to slip. The S&P 500 now up 1.1%, NASDAQ up 1.6%, and the Dow up 0.7%. The 10-year Treasury yield at 4.27%, and the 2-year yield at 4.67%. Market Drivers is brought to you by Interactive Brokers. Discover the future of trading with their next-generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. And that's your Bloomberg Business Flash. Paul and Alex.
All right, Amy Morris, thank you so much. Lovely to hear your voice on this Wednesday. Happy Wednesday. Happy Wednesday, Paul. Happy Hump Day. It is also the 20-month anniversary of the bull market run in U.S. stocks as of today, and appropriate them. And we seem to hit record high after record high after record high. I don't know. Does this set us up for something that happens at 2 or 2:30, or is the direction of travel just like as I joked about a couple weeks ago? People just want to buy stocks.
Yes.
At the end of the day,
I've referenced that many times.
you just want to buy stocks.
I can't think of anything better.
Anything is going to just move you to buy stocks. It raises the question, what happens when that party ends, but what's going to end the party? All right, well, Norma Linda joins us from Bloomberg News. She's going to dive into some of the market internals that we're seeing. One thing that's striking to me is that real estate stocks are outperforming. Like, this isn't just a tech story today. Why?
Exactly. I mean, every time that we see numbers like this that we're seeing this morning, especially as we look at the CPI print, you're going to see these interest rate sensitive sectors rallying, and of course real estate being one of them. And as we know, it's really been a tale of two stories when we think about real estate. You've got the residential side, you've got home builders really soaring for a buoyant rally, and then you've got commercial real estate really struggling to keep up here. But this morning we were seeing real estate as the second best performing group in the S&P 500, as you mentioned, right behind tech. And this has traders really pricing in a rate cut come November. Investors are really optimistic about that near-term rate relief. We're seeing digital real estate stocks, including Redfin and Zillow, soaring this morning. Zillow actually had some insider trading happening. We did see from a director, they disclosed late yesterday. So really something I'm keeping an eye on this morning. My team is really focused on this.
So all of a sudden, commercial real estate won't die. The housing market will pick up. Like, this is what this story is.
I mean, that's what traders hope, of course. I mean, I went to a real estate conference last week. It's NAREIT. It was here in Midtown New York. And the story that I was really getting from a lot of these companies is that we have maybe seen the bottom for a lot of these REITs, and we're looking at commercial real estate, and we hear about a lot of woes, but it does seem as though there could be some positivity heading forward.
I think what we heard from, I guess it was Ken Fisher
Monday.
Again, a big New York, well, just a big commercial real estate developer and owner overall with a big presence in New York City. He says, we're starting to get price discovery here. Buyers and sellers are getting deals done. Now, unfortunately, they're deals at huge discounts to where they were before, but that marks another step in kind of forming a bottom, is when you get sellers finally saying, okay,
exactly.
I now know where the market is. This is the market. As painful as it is, this is the market. That is a step, I guess, in maybe forming a bottom.
Yeah. I mean, that's it, right? You might not like the price, but the bank doesn't own it.
Right.
At the end of the day, right? Also, though, Oracle, so I was on set yesterday when we broke earnings. I mean, it was so interesting. They all partnershiped with everybody at this point. The stock, is it at a record now? Or
yes, we actually are seeing it at a record high, up as much as 13%. And of course, this is after that news that you mentioned yesterday. We got some earnings, better than expected bookings, and of course, a bunch of partnership deals with tech rivals. Of course, this is giving a bit of a boost to its chairman, Larry Ellison's effort to redefine the software maker as a major competitor in the business of cloud computing. And it's just interesting as we think about tech and just this whole rush for AI. Everyone's in a race. They want to be at the front. And it seems that Oracle is benefiting from those numbers put up yesterday.
So, of course, what do? I type in Rich Go to see where Mr. Larry Ellison is on the world's richest folks list. He's number 9 right now at $137.9 billion. He's up $15 billion just this year to date. So good for him.
Yeah.
Nice. You know who's not there?
Who?
His son.
Yes.
And he's probably somewhere
yes.
licking the wounds from that Paramount deal. And just talking about records, Apple.
Yes.
Do we feel like this was a buy the rumor, sell the news, and then buy it again situation?
I mean, it was interesting because especially after we did have that event earlier this week, everyone was a bit skeptical. I mean, you were hearing a bit of mixed reviews here, but it does seem that it was a bit of a positive feel coming out of it nonetheless. And of course, what the focus really has been is that Apple was really pouring a lot of its money and attention into developing Siri. So apparently Siri should be able to listen to a bit more of our commands and compute it. And of course, this is in partnership with OpenAI. So, I mean, you do hear some critics saying that, why is Apple outsourcing the tech? Why aren't they working on the tech themselves? But then, I mean, some people are just thinking, Apple, they are perfectionists, right? They're not going to roll out anything that they're not 100% confident about. And so this partnership with OpenAI should hopefully spur that along a bit.
Stock up 3.6% today, up 11.5% year to date, and that's all in the last couple weeks.
It's like all since May, basically.
Yeah, $3.3 trillion in market cap.
All right, Nora, we really appreciate it. Thank you very much, Norma Linda, joining us from Bloomberg News on all of those top movers. Obviously, the big macro story is what we saw with CPI, and then looking ahead to that Fed meeting. This is the first time since 2020 that we get the central bank decision on the same day as CPI. And you could read the CPI in many different kind of ways. So let's ask Jeffrey Cleveland. He's chief economist at Payden & Regal. He joins us now. Hey, Jeffrey, what was your read on CPI?
Well, good morning. Happy Fed Day. I think you put it in context. Sequentially, to start the year, we had a 0.4 reading, then another 0.4 reading, then I think we had another 0.4 reading, and then we had a 0.3 month-to-month percent change for April for core CPI, and then this morning 0.2, or if you like, on the altitude 2 decimal places, it was 0.16. So this is great news. This is great news. It shows a cooling off in the underlying pace of inflation. On goods prices were down, but also services prices cooled during the month. So everything's sort of moving in the right direction for the soft landing narrative, but also in the direction that policymakers would like to see. So it's a great start to Fed Day.
All right, Jeffrey. So given that, how do you think our good friends at the Fed will digest this news?
Well, I don't know if it's irony or it's the perfect day for this, but I suspect at 2 p.m. your time, 11 a.m. my time here in Los Angeles, you'll get some news in probably the median estimate for core PCE for 2024 will be nudged up by policymakers. So they, as of the last projections they gave us, 2.6, that probably gets pushed up to 2.8. So in a day where CPI came in soft, inflation is seeming to soften, they're going to raise their inflation estimate for the year a little bit, just based on the math, similar maybe to what the ECB also did last week. So that's possible. They probably also reduced the number of hikes, cuts. I didn't say hikes in it when I said cuts.
Delete.
In the dots. Yeah. So they had 3 in there. That probably goes down to 2. It could go down to 1, but I think 2 is probably more likely. So that'll be interesting for the rest of the day. And then we'll see Chair Powell, how he puts this into context. I suspect he'll say this is good, but we need a few good months, not just one good month. So then we can argue later, is that 3? Is that 4?
Right, I was saying, is it 5? I've heard, like, how many months does that constitute? Which brings me to that inflation point you just pointed out, that they might raise it to 2.8%. Is the market going to take that as good news or bad news?
I think this is pretty well telegraphed. I mean, if you're looking at these numbers in the forecasting community, I think that's not controversial. However, the market, could react negatively. The other thing might be, Alex, would be not just the 2024 dot, but the 2025. So the median core PCE for next year, if that moves up a little bit, that could maybe send a message that inflation is a bit stickier. That could disappoint the market. So there's a lot of moving parts here that will have to play out over the course of the day.
So, Jeffrey, what do you think the Fed does here? I mean, I think the market is now pricing in, maybe certainly a November cut and bringing September back onto the table here. How do you think, what kind of messaging do you think we'll get around that?
Well, I think that's where it comes back to, okay, this is a good report. How many good reports do the policymakers need to see to become confident? Is it 3? Is it 4? Is it 5? If it's 4, I think that rules out a cut before the election. So we still have the first cut in December in our projection. I'm pretty comfortable with that. We'll have to listen to the Fed chair today and see if there's any reason to speed that up. I mean, the other thing to keep in mind here, talking to colleagues this morning, doesn't need to do a lot, I don't think. They're in a good spot. I said that a few times over the months on this show. The stocks are, at an all-time high. Labor market is holding up pretty solid. Some of the concern was if the Fed remained too high for too long, it would sink the labor market. That doesn't appear to be happening. And inflation is, things cooled off in May. This is good news. I fully admit it. But we're still above 2% on the year-on-year, whether you're looking at core PCE or you're looking at core. Yes, there's no rush to do anything here. So I think we'll just wait and see how the data comes in the next couple of months, then make a decision.
And that is why Bank of America, Savita Subramanian, who was on Surveillance, said things are kind of awesome for stocks, like cue the Lego song. Like that's exactly the point that you're kind of laying out. My big question that I just don't really understand are shelter costs. So I appreciate that they were the biggest component of the May price increase. Why are we not falling faster? Like, we have been waiting for the rents to reset, for things to cool down in shelter for years at this point.
Yeah, that's come up a lot with clients, and I think the issue is a lot of clients point to the measures, private sector rent measures that may be capturing the marginal renter's cost of renting. So someone moving into a nice building there in Manhattan, where they have a nice door person, opening the door for them. Those rents may have come down. I don't know. You tell me.
I don't know. We don't live there.
That's what a lot of those private sector rent metrics capture. The BLS is running a different exercise and trying to look at the average cost to all renters. And this series just tends to move a lot slower than investors had hoped. So, the patience from a lot of investors, it's like, hey, we're seeing it. We're seeing the disinflation in the private sector rent metrics. That's got to translate, and it's taking longer to play out. So that's my preferred story.
Jeffrey, given this economic or inflation backdrop that we got, I guess, a better handle on today, what's your call on the U.S. consumer? Can the U.S. consumer continue to power this economy forward?
Yes. Yes, it can. I mean, we look at the consumer. We look at how many people are employed, how much they're working, what they're getting paid. And when you look at that measure, that aggregate measure, Paul, is still running almost 6% year on year. And we know the U.S. consumer is not a big saver. What they earn, they tend to spend. So really earnings matter, and earnings are holding up through the May data. So I think the U.S. consumer will have ample spending power. The other thing, if I have a few more seconds, is that in addition to income, U.S. consumers can rely on borrowing capacity. We don't think borrowing capacity is maxed out, so people could borrow more. Some cohorts of the U.S. consumer could also sell assets or borrow against assets to spend. Net worth is up a lot in the last few years, so we think that's a big component that could keep the consumer spending. So that's why when you look at our GDP call, we're still above trend for 2024. We think GDP will grow around 2.4, 2.5% this year. So, and that's driven by the consumer.
You are just like so awesome. You have so much energy and so much enthusiasm. I don't know if you get off air and you just like go to sleep, but it's so nice and refreshing to hear like a solid opinion and some enthusiasm. To that point, you talked about the consumers holding in. What about like restaurants and services and things that are directly tied to the consumer? Are those prices coming down, or is that demand and those sticky consumers keeping prices elevated?
It's possible that just the pace of consumer spending will keep prices stickier. Doesn't mean an acceleration. It just means that, on core, maybe we'll hang out 3%, 3.5% on core. We won't get back to, the pre-COVID sub 2% level. So that's entirely plausible. It's also, possible that consumers are shifting away, maybe spending less on some retail, on goods. They're spending more on services. So that's a shift that's underway. You've seen that with air travel. So I think that's one thing to keep in mind. It's not necessarily a slowdown in consumer spending, but a shift in how consumers are spending those dollars.
All right, Jeffrey Cleveland, thanks so much for joining us. Jeffrey Cleveland, Chief Economist at Payton & Regal, joining us via Zoom from Los Angeles. Speaking of spending on experiences, heard from Charlie Pellet yesterday, booked another cruise.
So how many cruises does he have this year?
I don't know. He's going cruise crazy. I don't know where he's going, but those are the people that I pay attention to. Like, what are the people spending money on? And I think Charlie's probably as representative as anybody out there, and he's spending on experiences.
Right. So it's still like it's still the experience part. And then anecdotally, so I live in Brooklyn, and usually on the weekends in the summer it's like ghost town, right? Because everyone goes away and stuff. And there's a couple popular restaurants like right on the corner of our block, right? And you think during the summer you can really just walk in. They're booked solid during the winter. Now I go online to see if I can get a reservation like 3 days before on a Friday in the summer, and I can eat at like 4:30 or 11 p.m. And I'm like, it's the summer. Like, aren't we done with this? And that, I don't know what that tells me, but it tells me something.
Well, is this the place you get your $300 dinner with one glass of Prosecco?
No.
Okay.
That is not that place.
Okay.
We will not be going to that place again. So I don't know if that means like people are traveling less and staying home, but they're still paying for stuff and they're still going out, or if they're just doing all of the things, in which case you have a hotter consumer and then those prices stay a little stickier.
Yeah, so we'll have to see. But again, the inflation print today came in, more moderate than expectations. I don't know what impact that has on the Federal Reserve, but maybe it has a little bit of an impact on, the dots, which we'll see. And again, folks, if you want to see where these dots are kind of lining up and how they've changed, you could go to DOTS Go on the Bloomberg terminal.
And we'll obviously break that all down for you when the Fed comes out. Also taking a look at the terminal rate as well. It was revised higher last time. It's 2.6%. Does that revise higher as well, which would mean a shallower hiking cycle overall. So lots of things to consider coming at 2, and then Powell's presser as well. The markets, though, they made their call. They like everything that they see. Volume is hot, and equities are at a record. Coming up, we'll talk Oracle with Anurag Rana of BI. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Brokers studio, I'm Amy Morris. CPI data came in below most analysts' estimates, bolstering bets that the Fed will cut rates this year. And of course, we'll be hearing from the Fed in just a few hours. The markets are reacting to all of this. S&P 500 up 1.2%, that's 65 points. NASDAQ up 1.8%, or 307 points. And the Dow is up 0.5%, or 197 points. The 10-year Treasury yield is down 3%, 4.27 now, and the 2-year yield at 4.68%. We're also watching Broadcom. Earnings are coming in later this afternoon. They're expected to show a sharp boost thanks to a demand for next-gen AI chips. Shares of Broadcom now nearly 2% higher. That's your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Amy Morris. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from the Interactive Broker Studio right here in Midtown Manhattan at Bloomberg headquarters. And we cover all the top news in business, finance, and economics with our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. They know everything. One thing they also know about is Oracle. That stock is up almost 12%. It is at a record high, and it was really about earnings yesterday. They announced a ton of partnerships to show some AI strength, and they have a huge amount of growth in front of them. Anurag Rana is Bloomberg Intelligence Senior Technology Analyst, and he joins us now. Hey, Anurag, walk us through the big highlight that you think caught investors offside here for Oracle and why we're seeing a record today.
Yeah, I think the biggest thing in our view were the two partnerships that were announced, one with Google and one with OpenAI, from a future point of view. At the same time, we continue to see strong demand for the cloud infrastructure business, which has been kind of the story on cloud, on Oracle for the last, you could say, 18 months or so. So that remains strong. But remember, prior to going into the quarter, there is a lot of noise about software spending slowing down, but that's on the application side. That's a different kind of the business. But on the infrastructure side, where you're hosting somebody's application or a workload, that business is still doing well. So it's good for Amazon, it's good for Microsoft, and now it's actually good for Google. Oracle also.
Yeah, great tweet out by David Faber this morning. Larry Ellison's net worth has increased by over $17 billion this morning on Oracle move, more than twice the value of the entire equity check Skydance and Redbird were writing to take control.
Oh my God, I love that.
Paramount. So just put it into context. A good day for Mr. Ellison, not such a good day for Paramount. So, Anurag, can we put Oracle into our basket of AI stocks now?
Yeah, I mean, we've been talking about it for a while, that they would be most likely the fourth largest cloud infrastructure vendor down in the future, right behind Amazon, Microsoft, Google, and then it'll be Oracle. Now, remember, everybody's trying to get the workloads or trying to figure out how to put their AI experiments out in the cloud just to see what they can do with it. And they're running short of capacity. So when you look at a company like Oracle, which has deep pockets, can actually afford to spend more. They announced last night they're going to double their capex this year. Wow. So that's going to be somewhere around $14 billion or so for the next 12 months. I mean, they can spend the money, so people will come to them.
So let me just dumb it down for me here. So Microsoft and Google then are using Oracle stuff for their AI cloud infrastructure. So all the language model learning things that happen and all the data they're collecting for AI goes now to Oracle's cloud or Oracle's hardware software?
Well, think about it. That let's assume that Oracle is an electricity provider, and if for any reason Microsoft feels short of it, they can go out and rent some from somebody else. I mean, because everybody is getting a lot of workloads or incoming inquiries to do things, but they're running short of capacity, and that's where they can go out and borrow. But when it comes to Google, what they basically are doing is they're saying we have a lot of companies, let's say banks and airlines, that house their data on Oracle's databases. They're going to take their servers and put it in Google's cloud data centers. So if anybody wants to run, you could say, an AI or an ML machine learning algorithm, they can then tap into that data that's housed into the Oracle database so that they can run those queries faster.
Alex, listen to this valuation story here. This is just another one that's very much like NVIDIA in terms of valuation. Trailing PE on their fiscal 2024, which ends May 31st, 24, stocks trading about 36 times earnings. On forward earnings, just on their May 2025, 22 times earnings.
Oh.
I mean, it's another one of those NVIDIA where this is a company that appears to be growing itself into the multiple. How do you think about valuation here, Anurag, for the Oracles of the world, for the NVIDIAs of the world, now that it seems that boy, it's kind of a new paradigm here with AI.
Yeah, when you look at cloud infrastructure companies, one could argue that Oracle's slightly cheaper than all the others. But at the same time, their cloud infrastructure business is small, so small compared to the overall pie, which is not growing as much. Remember, after all said and done, for next year, Oracle may grow sales, let's say around 11-12%, somewhere in that range. So it's not anywhere close to where NVIDIA is going to grow, their revenues for the next 12 months.
Do you feel then we're appropriately priced here?
I think it's so hard to say because one thing could happen is we could see a big spike in workloads in the second half, and that would require more cloud workloads. So it's really, we're trying to honestly live this on a week-to-week basis at this time, depending on how we see semiconductor demand at this point.
All right, so let's step back and look at your space in general here, Anurag. When we think about, I feel like we're learning something, or at least I am, every day about AI, the cloud, the spending associated, where the spending's coming from. So as you sit back and you're constructing a basket of AI stocks, what would you throw in there, in order, would you say?
Good question.
Yeah, it's a very good question. And in fact, everybody's trying to figure that out. But when you look at the AI basket, the bigger companies on the chip side are the first one. So that sits NVIDIA, Dell's been a bigger, somewhat of a player over there. But when you come to the software side, the number one company from an AI exposure is Microsoft. And that's because of its partnership with OpenAI. Now, when you look at the downstream play, it is the cloud vendors. Now, they have a very small portion of their workloads coming from AI, but that's going to rise going forward. That's going to be the likes of Amazon, Google Cloud, and then Oracle Cloud. So these are the infrastructure players. Then the application companies. Now, these companies are right now experimenting with products. They don't really have a full, massive suite out there. That's the like of Salesforce or ServiceNow, companies that are experimenting with it, or will have smaller products or newer products coming in. Adobe is actually another one that actually stands out for us because they have a product that's working very well, and they report tomorrow night, and we'll see what they do about it.
Oh, really? Because I feel like, isn't the whole thing with Adobe is that they haven't unveiled the right AI product or anything along those lines?
Well, they have one for creating images, so that's doing really well. The next one everybody's waiting for is the AI product that can create videos on the fly. Now, the big controversy on Adobe is that, why do I need to buy a software when I can create these images through, let's say, ChatGPT? But it's not just about creating images. First and foremost, when you use an Adobe product, you first of all are not worried about copyright issues. Second thing, you really use Adobe for editing and the entire workflow process, not just creating images. So creating images can be a commodity, but editing and actually giving out a big story, you still need a software for that.
So as we step back, Anurag, I know we talked over, and we talking to you and Mandeep Singh from Bloomberg Intelligence, you had talked about slowing rates of growth for tech spending. What's the outlook for the next couple of years?
So I think we are hopeful. So this year, which is 2024, all we are seeing is reallocation of the budgets. We are hoping next year we get incremental budgets by companies that are going to allocate some funding, especially for AI, and they don't have to then borrow funding from other areas such as consulting or old kind of hardware, etc. That would drive a bigger phase of, you could say, improved growth rates out there and improving estimates. So far, for bulk of the companies, we've only seen estimates go down. And for the first time, we saw some hope. For example, in the case of Apple, we may see some estimates go up next year because it could drive, or the craze about AI could drive people to embrace the new iPhone when it comes out this fall.
Before we let you go, I want to just talk about CapEx, circle back to Oracle for a moment, kind of end where we started. You mentioned they're going to double their CapEx budget. How firm do you feel like these kind of CapEx budgets that these tech players are talking about, how firm are they, depending on the political landscape, depending on demand, et cetera?
Yeah, no, I'm fairly confident of that because they've already getting orders for those workloads. So they start building, let's say, a data center or expanding their data center only after they have orders from people. So you have a fair amount of visibility into incoming demand before you actually build out capacity.
Amazing. It's really great. Thank you so much. I envy your job in some ways because it's like you're learning a whole new industry in some ways on the fly and like how to value it, and that's going to be really fun to suss out. Anurag Rana, Bloomberg Intelligence, a senior technology analyst. Always appreciate you. Let's go to my world for a second because I know you're going to be really excited about this, Paul. Oil inventories I say this because we saw a pretty solid build here in the U.S. and we weren't really expecting that. Refineries worked a little less than we had expected, and so you have a little bit of a buildup in inventories. But oil's still holding up.
Yeah,
oil's still holding up.
I saw that, and I expected to see oil down, but it's actually up a little bit.
So there were new sanctions put on over in the Middle East related to Iran, the Houthis, and that sort of helped the geopolitical risk premium a little bit in oil prices earlier in the week. But Citi just put out their monster quarterly report on all commodities today and said that in the next year they're looking at oil in the 60s.
Really?
At 60, yeah, because of just too much supply. There's just so much capacity, like from the Middle East, and then actual supply coming out of Brazil and the U.S. I have to think that the Saudis are not going to like $60, and that's going to be interesting.
They need it because of they need the revenue for all their social programs.
Yeah.
Right.
So how much more capacity are they going to take out of the market to support prices? Anyway, I nerded out there on you. I apologize. But really, it's a buy everything day today, let's be honest.
Let's be honest. All right, I'm in the world of sports here. NBA all-time great Jerry West dies at the age of 86. Again, one of the all-time greats. And if you haven't seen him shoot free throws, go YouTube, check that out. With our news in New York City, here's Michael Barr.
Thank you very much, Paul. Alex, Amy, Secretary of State Antony Blinken is criticizing Hamas for not taking a proposed ceasefire deal with Israel. After nearly 2 weeks of silence, the militant group now says it wants changes to the offer, which was crafted by the Biden administration and endorsed by the United Nations. During a news conference today in Qatar alongside the country's prime minister, Blinken said the U.S. will continue to push to close this deal.
We discussed those changes last night with Egyptian colleagues and today with the prime minister. Some of the changes are workable, some are not.
Blinken contends Hamas could have answered with a single word, yes. Instead, Hamas waited nearly 2 weeks and then proposed more changes. A rush hour chase involving a hijacked city bus in Atlanta was finally brought to an end when police threw down spike strips. Witnesses saying that Joseph Greer was being disruptive on a city bus. When a fellow passenger asked him to quiet down, police say Greer pulled out a gun, shot that person, and then approached the driver saying, "Don't stop this bus or else worse will happen." The chase spanned 3 counties and ended only when the bus was disabled by police. Atlanta Police Chief Darren Shearbaum says Greer was arrested.
Mr. Greer is a convicted felon. 19 prior arrest cycles that appear to be armed with a handgun. They use that handgun on citizens on the bus.
Police say the passenger who was shot for asking Greer to quiet down later died. He was the silhouette on the NBA logo. You heard Paul mention it. There's word Hall of Famer Jerry West has died. West had a long, legendary career with the Los Angeles Lakers, winning the 1972 team championship. He was also head coach of the Lakers. Jerry West was 86. The Boston Celtics and Dallas Mavericks play Game 3 tonight in the NBA Finals. Celtics up 2 games to zip. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Brokers studio, I'm Amy Morris. The Consumer Price Index, a key measure of underlying U.S. inflation, had its tamest showing in nearly 2 years. Price increases moderated across the board. Federal Reserve officials looking for signs that they can start to lower interest rates. And while we wait to hear from the Fed this afternoon, markets are moving. S&P 500 up 1.25%, NASDAQ up 1.7%, the Dow up 0.6%. The 10-year Treasury yield at 4.26%, and the 2-year yield at 4.67%. NYMEX crude oil is up 0.7% at 56 cents. Now trading at $78.49 a barrel, and the Brent crude is up 0.7% or 60 cents. Now trading at $82.54 a barrel. COMEX gold up 0.6% or $14.40. Now at $23.41 per ounce. And that's your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Amy Morris. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are live from Interactive Broker Studio right here in Midtown Manhattan. It is Fed Day. It is CPI Day. So what do? We talk to one of the best, Danielle DiMartino Booth. She's CEO and Chief Strategist for QI Research. We love the strong opinions that you have, and we love how you look at the market. Okay, so you're pessimistic on the economy. Is that a fair statement to say?
Yes, it is fair. I'm right there with Anna Wong, and I've been saying it since January that we likely went into recession in October of 2023. That's when the McKelvey rule was first triggered. It's got a flawless track record back to 1968. It's kind of like the Somme rule, but it's devised differently by the former chief economist at Goldman Sachs. He was interviewed in January of 2008, and because his McKelvey rule had been triggered in December 2007. And they asked him at the time, the Wall Street Journal, are we in recession? And he said, oh, I'm going to have to wait and see.
Mm-hmm.
So of his own rule, he said it might be different this time, but it wasn't. It wasn't. We didn't find out for 366 days from the National Bureau of Economic Research that the recession had been dated to December 2007. But we know that once the McKelvey rule is triggered, that we're typically in recession.
But then we have this whole record high in the equity market.
Oh, yeah.
Everything's kind of awesome.
It's supposed to be this way.
Buy bonds, yields are lower. It's supposed to be like this right now.
It is. You typically get a good 10% blow-off rally by time kind of when Main Street starts to understand that we're in recession, which, Chair Powell acknowledged that last time he was at the podium. He mentioned Indeed.com. He mentioned University of Michigan and households starting to say, oh my gosh, if I lose my job, I'm not going to get another one. Kind of from that moment of the Fed recognizing that Main Street sees that we're falling into recession until when the Fed actually cuts rates for the first time, you tend to see a good 10% rally in the stock market.
So what will we hear from our Federal Reserve this afternoon, do you believe?
I think we're going to hear either 2 or 3. I would not be surprised to see the 3 rate cuts stay on the table. The unemployment rate was not rounded up to 4.0%. It was 3.96%. It was a good, strong 4%. And given what we've seen in the past, when the unemployment rate moves up, inches up, 1/10 of a percentage point, a tenth, right? That's exactly what we've seen for the last 13 months. Very small movements. But typically when we see, your Bloomberg BCY function, when bankruptcies start to run as they're running this month at the fastest pace since the pandemic, companies with 50 million in liabilities or more. There was Coach last night that filed, transportation company. Typically when we see an acceleration in bankruptcy filings, we also see the increases in the unemployment rate tick up. So it's feasible that we could see in July and in August a large enough move to put the Fed in play come September, November, December. Maybe those 3 dots stay on the plot today.
So BCY Go.
BCY Go.
It is really awesome. Has a nice little pie chart that shows where the bankruptcies are coming, and the most are coming from consumer discretionary. And this is a period over 1 year. It breaks down industries, it breaks down the name, and then the liabilities. Very cool. Thank you for that.
It's one of the richest functions on the terminal.
That's our desert island function, is what you said.
That is my desert island function. My desert island go-to financial indicator would be the MOVE index, which should be a pure play on Treasury market volatility. However, when Treasury rates fall and the MOVE moves up, it's telling you what's going on in BCY, that there's a credit event rumbling somewhere under the surface. Because if Treasury rates are falling, then Treasury volatility should fall. When they move in the opposite direction, there's a lot of tension in the system. That typically starts to flag, there's issues with the banking system or lending. And what are we seeing? We're seeing commercial and industrial lending contract right now.
Should the Fed have already been cutting?
Likely, right? We're 11 months in to the Fed holding after their last rate hike, heading into the Great Recession. December 2007, the Fed held off for 15 months. It was the longest in history. So the longer they kind of hold off, the bigger the potential for a policy error, that they've waited too long.
So I have to say, when Danielle's on, I get write-ins to be like, ask her this, ask her that, ask her this. So this comes from a listener. Do you think that the next rolling 6 months of economic data remains noisy, or does the deterioration remain consistent? So it's like a drip, drip, or it's like a cliff?
I think we're starting to see something that more closely resembles a cliff. You have essentials inflation at QI Research. We parsed them out, running at 4.7% year over year. It also happens to be completely out of the Fed's control. Pure discretionary inflation. It used to just be a goods deflation story. But what we saw this morning was goods and services that are discretionary in nature. These are things that households want to buy but do not need to have. That's at 0.1% year over year, at the cusp of falling into negativity. We've got hotel rates falling, car rental rates falling. Airfares are coming down. So the services inflation that had been the happy story post, well, everybody's bought enough of what they need, so they're not going to build themselves an extra deck in the back of their house. We're actually seeing that combining now with massive disinflation on the services side. So the Fed's job is basically done, because all they can control is what's discretionary in nature.
Did they not look at that data? Did they not value this as highly as maybe others do?
Of course they look at the data, but Powell seems for some reason to want to stay higher for longer. Maybe he gets up at the podium today and only talks about non-farm payrolls and not the unemployment rate and not the zero print on headline CPI. Maybe he just says that's an anomaly of energy prices. Who knows?
Where's the service? You mentioned services disinflation. You mentioned a lot of services disinflation. Where?
Well, we're seeing it in hotels. They're down negative. They're 1.7% year over year. We're seeing that play out in very weak occupancy trends. We get the STR data on a weekly basis. Citi does a good job of providing reports on that. Outside of a bump at Easter, we've seen occupancy negative year over year, week after week after week, beginning the week after New Year's. And that is telling you what a lot of, gee, why is this hotel selling for pennies on the dollar? That doesn't make any sense. Americans are still spending on services unless we've pulled back, unless we're just focused sheerly on, okay, fine, auto insurance rates tick down just a little bit. They're still up 20% year over year. The things we must buy, that inflation's running at 4.7% year over year. You are pulling back on anything that is discretionary, including travel.
Dot plots, do I care? I mean, I've got a function for it.
We care a lot about the dot plots today, because the difference you could drive a Mack truck between the difference between the market reaction of 3 staying or it being whittled down from 3 to 2. I do think that markets right now are assuming 2, given today's CPI print. If they keep 3, then you're going to look to Powell at the podium to talk a lot more about the second mandate of maximizing employment.
Great stuff.
Yep, always.
Danielle, thank you so much. We appreciate you stopping in.
Great to be here.
It's great to get a counterintuitive, passionate voice on stuff. Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. Interesting. I don't want to be an economist. I feel like everything is a Rorschach test.
Yes.
Like everyone has the same data, but then how you filter it through your models gets you to different conclusions. But you have to wonder.
I tell you, the market likes it today. The S&P 500 up 1.25%. The Nasdaq up 1.8%. The Russell, will point out, that's kind of where the game is right now, up 2.9% here today. So a broadening out, which a lot of market strategists will tell you that's a healthy thing for the markets in general, to see a broadening out of participation. It's not just the big cap names. And yields coming in sharply. The 2-year, most interest rate sensitive here, to policy, down 15 basis points, 4.68% on your 2-year Treasury. The 10 years off here, also about 14 basis points, 4.26%. WTI crude oil up a little bit here, up about 0.5%, $78.30 for WTI crude. We're going to have more coming up. This is Bloomberg. Good morning.